Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 293rd VideoCast podcast for the week ending May 29th, 2025. Got a lot to cover today, but as always, family first. So, Mimi completed her first year at 6'8 Water Polo Academy and can't wait to return in the fall. Annabelle swam in the Speedo Grand Challenge where she discovered a new best event, the 200 IM individual medley. She won the 200 IM at the meet with a time of 2:31.29, beating some nationally ranked 12-year-olds and smashing her own Nova team record by 2.73 seconds. So this was Irvine Nova Aquatics congratulating her. Super proud. Great job. Awesome. As always, did some channel checks at Irvine Spectrum. We went to see, obviously, sent the kids to see Lilo and Stitch on Memorial Day, so they got to contribute to Walt Disney's earnings, which we own a significant stake in. And Caitlin and I saw Mission Impossible, first time in a movie theater for a long time. Really enjoyed that. Unfortunately, that's Paramount and we don't own any, but we just simply enjoyed the show. I was surprised because we got out of the movie theater. It was like 9 o'clock on Monday night, and I walked by Vans, and Vans was packed. And maybe this has something to do with it. These low profiles, two of the girls were buying these. That's a new product. And then this I haven't heard anything about, but I almost bought these, and I may go back and get these brown ones. Already have 3 pairs of Vans in my closet, but they're called the Curren, Curren. And I thought these were super cool. So yeah, I might have to go back and get those. You can see here more of a crowd doing my channel checks. This is my wall of flags. When I go to special golf courses, I like to buy a flag. And this week, last week, I got to play Emirates Golf Club in Dubai. Absolutely incredible time with my host, Philip. We'll show you some pictures there. There they are. Okay. That's Philip in the middle. The Emirates Golf Club was truly spectacular. It was a little warm this time of year, but it was good to work off some of those beautiful breakfast buffets and lovely dinners, etc. David and I are wearing the Hedge Fund Tips hats, and Philip informed me, he's like, yeah, it is close to summertime in Dubai. Black is not the most reflective color. He was smart enough to wear a white hat. That's part of the city in the background there. Super cool time of my life. Then I went on a mini tour the last day, went to the top of the Burj Khalifa, which is on top of the Dubai Mall, is at the bottom. The Dubai Mall is nothing like I've ever seen before. I kind of joke now, people say, how was Dubai? I said, well, the streets are paved in gold and the opportunities are unlimited. That's the model in the base. And then, I did a presentation for the YPO. Shout out to my friend Adam Johnson, who's on Fox Business all the time. He introduced me to Craig Bridgman, who asked me to do a presentation to the Dubai YPO group. And then a couple of the members, that's Craig, that's his wife. That is Amin Malmuk. He's doing an incredible, it's like a live streaming commerce site. He went to Harvard Business School. He worked for Amazon before. And then Abdullah M. Alishram hosted us at the Arts Club. We're very, very grateful for that. I'll see you when you're in California. Just an incredible time. They just kept bringing courses and courses, and we were sharing business anecdotes, talking markets, just a wonderful dinner. And then I guess more pictures from the top of the Burj Khalifa. Yeah, like a kid, I was excited. This is the mall. It's the most unbelievable thing. I brought my host, Philip's incredible wife, Tammy, chocolates from C's Candies. And in the US, you can kind of get them different places, but really you mostly get them either in airports or in the state of California. Buffett owns it. Obviously, Warren Buffett, Berkshire Hathaway, they had tried to expand into other states in the past, but there was this special feeling in California, so they just stayed concentrated in California. So when I go places, I sometimes try to bring people C's because it's not something they can get every day, and it's a really spectacular candy. And so So they were so hospitable. Number one, Tammy bought my daughter's Dubai chocolate, and not just any Dubai chocolate, the best Dubai chocolate, and like 6 different variations. It was just unbelievable. Brought it home. By the way, traveled perfectly in my golf case in the cargo section of the plane. Came back, wasn't melted at all. I guess it gets pretty cold down there. So yeah, I brought C's candies and thinking like, wow, this is something they can't get in Dubai. And of course, I'm in this mall, which I've never seen anything like it in my life. 4 stories, like it probably goes for a mile. Every possible highest end, everything you could ever imagine. Every brand under LVMH, every Hermes, etc. And then as I'm walking to the entrance to the Burj Khalifa to get to the top of the tower for my tour, like any good tourist, what do I see? C's candies. I mean, you can't make this stuff up. So, of course, I had to text Philip and say, I'm sorry, I thought it was a special gift, but apparently there's nothing you cannot get in Dubai. So, that was an eye-opening experience. That's a special market that I got to go to and see all the local merchants. Really, I got the girls some really cool stuff there. Thanks for Charlotte for putting that all together. It was a special, special time. Also, pictures are starting to roll in from all the amazing amount of support and orders we've gotten for the hedge fund tips merch. The golf polo is actually very popular, and the hats and actually everything, the mugs, the t-shirts. So here's the first few pictures. Obviously, we were wearing our hats. Then Rob Klopfer, I think I covered last week. John, Janik, Jim Gelb, Cork Snyder. If you remember Cork, I went to go speak to his students in Westminster High School. Anyway, he's the AP stats teacher, and he got a t-shirt. Looking good there, Cork, and he's doing this long bicycle ride this weekend for charity, so good luck with that. I'm sure you'll be great. And that is it on the pictures. Let's get down to business. First and foremost, had the pleasure to join Jared Blickery and Sydney Freed on Yahoo Finance, Stocks in Translation, a 20-minute kind of podcast back and forth. A lot of really good points covered here about moats, about themes, about companies, etc. Want to especially thank Taylor Smith Clothier for having me on. We're going to listen in here.
Welcome to Stocks in Translation, broadcasting from the New York Stock Exchange. I'm Jared Blickery, your host, and with me as always is the voice of the people, Sydney Freed. First, please like, subscribe, and comment on Stocks in Translation on Spotify, Apple Music, Amazon, or YouTube. And today we are welcoming back Tom Hayes. He is the chairman and manager of Great Hill Capital. He is a veteran value investor with over 2 decades of experience spotting market turnarounds in tech, banks, energy, and now housing. And today we're going to be talking about the Great Value Renaissance, a phrase coined many moons and shows ago. Our word of the day is moat, designed to keep out invading armies, and today they repel competitors. So which castle is Tom investing in? And this episode is brought to you by the number 7.5, as in years. That's how long Realtor.com says it will take America to build enough homes to finally close in the housing gap and fix the housing shortage. And Tom has some stock picks to potentially make it worth your while. So before we dig in, Tom, let's talk about the most recent market action. You're a value investor. You like the booms and the busts, and we just had one. What are you swimming in here?
I call it the big, beautiful dislocation. You had $1.2 trillion of forced sales in the hole from hedge funds and CTAs at the beginning of April. And then President Trump put out his tweet, now is a good time to buy stocks, and the market's up.
And did you?
Not only did we did a conference call for our clients the day before because people are really worried, right? It looked like there was no bottom.
Yes.
And we went company by company. We went through balance sheet. We went through income statement. We went through free cash flow. And what we saw invariably was all these metrics are going up. What's going down? The price based on the short-term noise. Long-term, they've got the moats in the business. Even if the worst-case tariff scenario came to pass, these would be the biggest players, and they'd pick up share from the smaller players that were hit the hardest. And that's why a moat is so critical.
You know, this leads to our word of the day. Thank you for that, Tom. Perfect segue. A moat is a long-lasting competitive advantage. So think a castle moat, like a safeguard to a firm's profits. So Warren Buffett hunts these kinds of corporate defenses, and we have a few Oracle quotes now to set the mood here. In 1991, he gave a lecture in front of Notre Dame, and he said, the most important thing in evaluating businesses is figuring out how big the moat is around the business. And what you love is big capital and a big moat. So is that what we're seeing here in some of the names that you're looking at? And who has them?
There's no question. I mean, sometimes you have a monopolistic moat, like Boeing has a duopoly with Airbus. That was not a hard one to figure out. It dropped down to $129 in the most recent sell-off. It's very simple. If you want to go to Airbus, that's fine. You just have to wait 20 years for your next plane. So that's an easy one. Then you have brand moats, like Buffett invested a lot in Coca-Cola in 1989, 1990. Now his dividends each year are bigger than his original basis because they keep increasing the dividends. It has that brand moat. It has the distribution moat. So we look for businesses like that and brand moats. And we're going to talk about a few names like the Stanleys, like the DeWalt's, like some of those companies in the housing sector that people have been using these tools for generations upon generations, and they're not going to go to the second best because they don't last and they don't have that same type of brand credibility. So
it sort of sounds like if you have a popular brand or it's a popular company, you have a moat, but that doesn't feel right. Like, Is any famous stock have a moat or no? That's not how it works.
Well, look, Apple.
I was going to say Apple, yeah.
Apple has a brand moat. It has an ecosystem moat. It kind of built that monopolistic app store, which they continue to throw arrows, and he continues to create relationships with administrations, and the arrows keep hitting the wall. That's protecting the moat, and Tim Cook has done an incredible job at protecting that moat. Procter & Gamble for years had moats around Tide. That's been kind of diluted a little bit with the Kirklands of the world, et cetera. So you have to constantly be on top of the moat. You have to constantly analyze the moat, but the key is to start with a business that has a moat, because if the moat is there, your margin is, and you buy it at the right time. If the moat is there, you can make it through tougher times, the cyclical downturns, and you come out stronger, because in cyclical downturns, the smaller players with the weaker moats go out of business and you pick up share.
I want to get back to a name you mentioned a couple minutes ago, Stanley Black & Decker, because this hit my list Monday morning. And we're taping this the week after the latest tariff detente. Yeah. And that morning, I was looking pre-market at all the companies in the S&P 500. Who was leading? Stanley's at the top of the list. It was like 12, 15%. I hadn't looked at this stock in years. Yeah. What's going on there?
They have an absolute moat, and they're highly correlated to the home building industry, okay? So they have DeWalt, okay? They have Stanley, they have Craftsman, they have Black & Decker. So if you think about construction, if you think about projects, if you think about lower interest rates, which spurs the former, it's a huge leverage play on the recovery of construction, which is going to come in the back half of the year. And that's
the back half of the show.
And the back half of the show. Everyone's focused on the Fed. What they need to be focused on is what Besson is going to do with capital requirements with banks, the SLR. So he's going to...
And the SLR, the liquidity ratio.
Yeah, exactly. So what the case they're making is government backstop securities, i.e. treasuries, mortgage-backed securities, shouldn't be counted differently because there's no credit risk. And if they agree to that, which is common sense, because if there becomes credit risk, then we got a lot more to worry about than bank capital ratios. That will enable banks to hold a lot more. And they're going to hold a ton on the short end of the curve, which the Treasury can then use those proceeds. If you remember 2012, I know Sydney's not old enough.
This goes back to Basel III. That's what doesn't this remind you of Basel III?
No, it reminds me of Basel III.
All right, we're on the same page.
So they can use those short-term proceeds to reinvest on the long end of the curve, which is expected to bring 10-year treasuries down 30 to 70 basis points, which means a 30-year fixed for the woman on the street, 30-year fixed rate below 6. When that happens, boom time.
We know that President Trump wants lower mortgage rates, and so part of that, I'm asking, is that part of the Mar-a-Lago Accords? Because there's more to it than just that. There's other countries buying U.S. Century bonds, that's 100-year bonds, to bring down long-term interest rates, but I hadn't read that particular facet before, so that's interesting.
Yeah, the Mar-a-Lago Accord was predominantly rumored in the first quarter of this year, which was a currency reset, like you saw in Reagan's second term. I don't know that that's fully on the table yet. It's implicitly on the table because as China does a deal, so China knew the tariffs were coming. So what did they do ahead of time? They just devalued their currency by 20%. The tariffs were kind of in that same neighborhood. And as the deal is set, part of the deal is going to be get your currency back to normal. That balances out trade. So there's implicit. Will there be an explicit meeting where you have 8 parties together and they uniformly devalue the dollar? Bretton Woods, exactly. Plaza Accord. The answer is we don't know. But the trend of the dollar is right now you're going to have a counter trend bounce because everyone was bullish on the dollar. Now that the dollar's fallen a lot, everyone's bearish. So you get a counter trend bounce. But the trend, intermediate trend, is down. That's going to help earnings. That's going to help all the things that we're talking about here.
With everything going on right now, we still don't have, a lot of solid trade deals. How are you thinking about the market in terms of, companies with a moat, in terms of sectors? What do you like? We're seeing stocks come back to where they were like a month ago before a lot of this happened.
500 positive
exactly.
on the year.
Yeah. So what are you liking right now, as we're navigating this uncertainty?
Yeah, I think if you look at equal weight versus cap weighted S&P, the valuation for equal weight is 1 standard deviation below its long-term average, which in English means it's cheap. Okay, on a multiple basis.
493 is cheap.
493 is cheap. So you have to continue to look there for the Stanley Black & Deckers, which are part of that 493. I think we're going to talk about a couple other housing stocks as well. There's just a lot to do. The companies that were most impacted by tariffs, which, by the way, was Boeing, or the fear of the worst case, that's where you're going to find your biggest opportunity. I think the Mag 7 will rebound, a tradable rebound, but we can't overlook the fact that their earnings power has decelerated from 33% down to 16% and maybe a little bit lower. And that's part of the reason you've seen what they've done. Because when you think about tariffs, like how does that really affect Google when they're not in China? And so on. So they've come down relative to their earnings power. The amount of capex that they have to spend to stay competitive, to keep share, has impacted their earnings, has also crowded out their ability to buy back tons of stock. Whereas the 493 announced record buybacks in the first quarter in the face of all this uncertainty, $665 billion.
Talk to me about China real quick before we go to break. We've talked about Alibaba in the last time we were here. Yeah. That is, it came up, it came down, but it's held on. What do you like about China now?
What I like is that Xi, after enough of social unrest and 25% youth unemployment, got his act together about a year ago.
Xi gets it?
Xi Jinping got his act together. Has done massive stimulus. He's now helping his country versus hurting his country, soldering them in their apartments. That didn't work. And people got tired of it after 3 years. So you're seeing global M2 money supply start to hockey stick. And a good portion of global M2 money supply is China's new stimulus, which started in the last 12 months. He's committed to taking the country to 70% consumption like the rest of the developed world. Alibaba's got 40% of the e-commerce market. They are a toll taker for domestic consumption, so they're going to benefit from that. They're going to benefit from being the #1 player in AI. They have a piece of all the AI startups because as the #1 cloud provider, new startup comes in, they say, we need compute power. They say, no problem, I got you covered. I'll give it to you for free.
And we'll take a piece of your business and a peek at your business, too.
We're going to take a peek and a piece. We're going to get equity. So you have equity in all the Chinese AI startups. Some are going to be 1,000 baggers and some are going to be zeros.
And Alibaba takes a piece.
Alibaba takes a piece. It's the granddaddy. It's like the casino owner versus the blackjack player. They get a piece of all the action on the retail, on the AI, and their models are outperforming OpenAI. Their models are outperforming DeepSeek. Their international e-commerce is growing at 40%. They got $80 billion of cash on their balance sheet. They're generating $20 billion of free cash flow. What else do you want to know?
Yeah, as long as Jack Ma doesn't get Mo Greens. Yeah, that's a bad joke.
And by the way, Ant Financial, the Chinese tech crisis started with the pulling of the Ant Financial IPO.
One, it was supposed to be the biggest IPO ever.
It's going to happen in the next 12 months, and we own 35% of that as owners of Alibaba. We own the stock shares in Hong Kong, 9988. You can switch out your U.S. shares if you're worried about delisting. I think it's a lot of noise, but as a fiduciary, I want to protect my investors.
Sure.
We still own derivatives in the U.S. because we can't replicate them in Hong Kong, and we're willing to assume that risk.
Wait, how do you move shares from international to U.S. listed?
Depends on your custodian, but you can call them and they'll just swap out because there's no currency risk. It's 8-to-1 pegged to the dollar, so you'll get eight more shares per every one U.S. ADR, but it's the effective same slice of the pie.
All right, hold that thought. We need to take a short break, but coming up, we're going to be talking housing stocks again in a runway battle to turn heads as well as profits. This episode is brought to you by the number 7.5. That is the number of years that Realtor.com estimates it's going to take America to build enough homes to fix the housing shortage. So it's a big gap, Tom, and you say it's a big opportunity. And I'm wondering how you're screening for opportunities here. We already talked about Stanley and the moat and all that. What else you got?
Well, look, when you had the gold rush, who made the most money? Was it the people looking at picks and shovels, right? In war, you don't want to be betting on the warring factions. You want to be betting on the arms dealers. So that's what we're going to be doing with the housing sector. So the DH, the Hortons, the Pulte's, the KB Homes, all the home builders, it's going to be a race to the bottom because what's going to take place is a couple of things. Number one, we're opening up federal land. Okay, we've got hundreds of millions of acres. If we open up like 1% of it, we'll have enough land. It's like 500,000 acres. Will be enough land to bridge the deficit.
Just 1% of the federally owned lands, which is a huge swath.
Okay, so we're short 4 to 7 million houses. Like you said, it's going to take 7.5 years to do that. And effectively what you're going to see is a race by the home builders. I don't want to be in that race because once that happens, once supply picks up, it's a pricing compression. But if you're doing the builders, the tools for the builders, the Stanley Black & Decker, the construction, the part suppliers like QXO, I think we're going to talk about, or what goes outside now that you got the electrical grid down every single month or so in some of the hurricane-ridden states. Sure. And the demand on the power grid, which is an aging power grid, you need a generator. And if you need a generator, the Kleenex of generators is called Generac. 75% of the market, the game is just getting started there. So those are our three arms dealers for home building that's to come in a massive scale in the next 3 to 5 years. Oh, and by the way, you got 72 million millennials, 45 million people between age 30 and 40 who need homes. Sydney knows, she's nodding in her head.
Sydney needs a home.
Listen, it feels like the American dream is slowly slipping away in that sense. Yeah. I have a question though. Do you recommend in terms of these kind of tool companies that you go straight for these single stock names or you go to like an ETF so you're just covering all your bases?
My clients pay me to outperform, so I don't go to
You're not going to an ETF. It's not thicker.
I mean, you could buy XHB and participate in a beta sense, but if you want an alpha sense, you got to do some work and say, where am I going to get the most return for the same amount of money? And that's what we try to do every single day when we get to work, and I love it. It's like a treasure hunt every single day.
Said Warren Buffett. You mentioned a couple names. What's your favorite story of all the names that you've ticked through so far? My favorite jockey, I like to bet on jockeys because I'm turnaround Tom, is Brad Jacobs. Okay, if you got QXO. Brad Jacobs wrote a book called How to Make a Few $1 Billion. It was a useful book because he actually made a few $1 billion. If you got involved with him in 1997 when he invested in United Rentals, you made 79 times your money. So 1 million became 79. If you got involved when he put 150 million in XPO Logistics in 2009, you made like 160 times your money. 1 million became 160 million. So now he's going to do the home building supply sector. He started with Beacon Roofing. This is a non-discretionary expense. Sydney, you'll figure this out when you get your starter home on federal land with an endangered elk in your backyard free of charge. That when your roof leaks, you don't think about, should I buy it? Like you think about, should I buy a pink iPhone or a white iPhone? You just call the person and you say, fix it. I don't like water in my living room. So Beacon Roofing is his first one. He paid 10 times EBITDA, a little bit rich, but he's going to double EBITDA. Why? Because that's what Brad Jacobs does. He brings in technology. He creates efficiencies. He doubles EBITDA. That's his platform company. Then he's going to roll up 10% of the industry. It's an $800 billion industry. He's going to get $50 to $80 billion of revenue. How much is he in now?
He's got 10 billion with Beacon, okay? And this was just announced. So he's going to do another 7-8x. The stock is probably going to do another 10x, by the way, because it doesn't account for the technology and the special magic that Brad Jacobs makes. He's a moneymaker. This guy earns for his shareholders, and here's the beauty. He put 150 million in QXO. He just put $1 billion of his own money in QXO. So in XPO, he put 150. In this one, he put $1 billion. We think, this is one you tuck away for 5 to 7 years. You probably wind up with a 6, 7, 8 bagger from these levels.
Kind of reminds me of Wayne Huizinga.
Yeah,
3 companies in the Fortune 500 over his lifetime, which is substantial.
And they were roll-ups, by the way. And by the way, it wouldn't surprise me. I'm trying to get Brad on my podcast. If
What's
that
your
was a
podcast
model,
name, by the way?
It's called Hedge Fund Tips with Tom Hayes.
All right.
It's #1 in the hedge fund category, which is a narrow niche, but we've been doing it for 5 years, and people seem to like it.
Tom, I need an invitation over here.
Oh, you can come on anytime you want.
Come on.
Yeah, come on.
People's voice knows hedge funds.
I have a different question for you.
Shoot.
Are you invested in REITs? And I'm going to define that for anyone who doesn't know. REITs are real estate investment trusts, companies that own, operate, or finance income-producing real estate.
Yes. We own one REIT. It's called Crown Castle. They're one of the biggest owners of cell phone towers. They just sold off their fiber business. They got billions of dollars for that. They use that to pay down debt. They have the legacy 40,000 towers that are just cash machines, basically require no maintenance. It's like owning an ATM. Every time someone uses it, you make a fee. It's the exact same thing with these towers. So now it's just going to be a cash machine. They'll buy back shares. They'll buy more legacy type towers. And these tend to be interest rate sensitive. So when rates come down, as we said, Beston's going to work his magic the second half. REITs will go up. Crown Castle will be a beneficiary. As far as real estate REITs, there are none at attractive enough levels at this juncture. We were big buyers of Vornado in the hole. If you remember during that big mini banking crisis, we thought it would take 3 years to double. It took 6 months to double, and we got out. So that one, sometimes they take longer than expected, like Alibaba. Sometimes they happen faster than expected, like Vornado. But the key is the framework is sound. Does the business have a moat, and are we buying it with a large enough margin to safety?
All right, we're going to stick with the entrepreneurial vibe here because today's Runway Showdown is all about value-driven CEOs. 2 chiefs strutting the catwalk with distinct approaches to turning opportunity into profit. First down the runway is the serial entrepreneur, dressed in relaxed business casual, confidently investing in under-the-radar, cash-flowing small businesses like storage units and car washes, quiet, consistent, and profitable. Close behind, though, is the turnaround specialist, sleeves rolled up, toolkit ready, eager to repair and revive neglected industrials, retailers, and manufacturers. Tom, which value pays off more reliably, the steady entrepreneur building a portfolio from the ground up, or the specialist who sees gold where others only see rust?
Well, I think it's a question of scale, right? You can make a tremendous amount of money buying small businesses that are kind of fragmented businesses, roll them up, get synergies, whether you do it with car washes, whether you do it with laundromats, et cetera. People do that. But if you want scale and you want control of capital, you need to be in bigger businesses. And that's what we try to do in the public markets. The beauty, I get approached with private deals all the time, and there are plenty of private deals. Most of them are betting on the future. We're guessing who's going to cure cancer, who's going to be the AI leader. I don't like to guess on the future. I like to bet on sure things, okay? And I want a business that's
Sound like Gordon Gekko.
I want to bet on businesses that have operated through many cycles, many downturns, and operated through and have a big enough moat, a strong enough balance sheet that I know they're going to recover just back to the mean. They don't need to be a home run, doubles or triples over 2 to 3 years. And you compound that with large amounts of capital, it beats, grinding and getting synergies from a handful of laundromats or ever as an entrepreneur. But I will say Brad Jacobs does a combination of that. So he has his platform company. He gets the public market multiple. You get a higher multiple in the public markets. And then he uses that currency and his ability to raise capital in public markets to buy defragmented businesses, smaller scale businesses, and tuck them into his platform company. And that's how he's created so much wealth for so many people over the years.
It's great. Tom, I want to switch gears here, a little more personal and advice-driven.
Okay.
So you study the markets kind of day in and day out.
Yeah.
I want you to share with me, with us, what's the one thing that you think that everyone needs to know about the market that either they're misunderstanding or sometimes misrepresented?
I think the number one thing, like anything in life, is to be consistent. So if you're just buying the overall indices, like a VTI, Vanguard, Total Market, or an S&P 500, buy it every single month, a fixed amount, okay? And the months that you really don't want to buy it, where your stomach is churning, you're afraid you're going to lose your job, whatever it happens to be, those are the months you should buy double. Because when you buy down, you get more shares, and over time, that compounds materially. So dollar cost averaging, that's kind of your base, you know? Put the majority of your money to compound that way. And then when you have excess wealth, you start to take some of that and you want it to be a little bit more aggressive, and you put it in different buckets, and you hire different managers like Tom Hayes. You hire, maybe a private equity manager, maybe a venture capital fund, et cetera. And you diversify with that excess. But start with the basics, get the compounding machine going, because it's the eighth wonder of the world. And it's created more wealth, this beautiful, amazing
The
machine.
ninth wonder right here behind us.
Exactly.
Hey, guess what? That is all the time we have. Really appreciate you stopping by. And this will do it for the latest episode of Stocks in Translation.
And we're back. And then I had the pleasure to, I don't know how they got my number. Bloomberg Dubai reached out to me on LinkedIn literally a day or two after I landed and asked me to go on Bloomberg Dubai. And I'm like, hey, I was just in your city. I would have been happy to do it in person. So I did the remote interview. Unfortunately, we're not going to play it because little did I know, the interview was in Arabic. So I'm joking with all my friends and saying, 1 week in Dubai and I already speak Arabic. So they gave me the questions in English. And apparently as I was talking, they talk over you in Arabic for the local audience. And that was that. But that was a fun experience. Then I want to thank Chibuke Ogu for having me in his Reuters article this week. And the quotes of the week. Know what you own and know why you own it. Peter Lynch. And this was a great example. We have seen, it's so interesting. So many people, I think, got shaken out that maybe bought Boeing at 150 and got shaken out last month when it went to 129. And we were on Varney saying, buy like crazy and loading the boat with options and spreads and all the different things. Well, the stock has moved now almost, it's moved 80 points, 80 plus points, got up to like 85 points in a matter of 4 weeks. Many of those options were up, many multiples, serious amounts of money in short period of time. We actually harvested millions upon millions of dollars of options in Boeing today, this morning, into strength. We sell into strength, we buy into weakness. However, we have not sold one single share of Boeing. Okay, that is a long-term holding for us. We do think it's moved very far, very, very quickly, and we wanted to lock in some of those profits. You can joke in coming weeks when it keeps going higher and say, Tom got it wrong. But the clients who saw the amount of multiples on those options will say, I'm so glad he took profits. So there we go. But we no change in view. It's just at some point you got to ring the register. And that was just a lot of money in a very, very short period of time. So Charlie Munger, it's remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid instead of trying to be very intelligent. And, I look at some of the questions that come in, and we've got a lot of great AMAs this week. And this is a mug from my friends. Thank you very much. Love this. It's my favorite color, by the way, other than, of course, Hedge Fund Tips Black. But it's I think, it goes back to Buffett saying about how sometimes the 130 IQ crushes the 160, because the 160 focused on so many unimportant factors and all these different variations and second guessing. And if you get to, kind of first principles, what are the 2 or 3 things that make 80% of the difference with any investment opportunity in any particular theme that you're in, and you stick to it and you know what you own, it's really just avoiding the stupid things, chasing the shiny objects where you're going to get that outperformance over a reasonable amount of time. And that's what this is all about, is trying to avoid stupid things and basic things that you can understand, that have durable moats, that you can buy them when they're down. And this is segue right into Benjamin Graham. A great company is not a great investment if you pay too much for the stock. Okay. Buying Boeing at 211, still a great investment, a lot different than buying it at 150 or 160. But it still has a lot of upside in it. So it's just getting great businesses when people are panicking. Right now, what's super exciting, I keep getting all these texts from literally people I golf with, like, what about SMR and all this stuff, because nuclear was in the news this week. And look, we had a derivative play and a multi-bagger in Rolls-Royce Holdings. They had SMRs. We were playing the engine servicing hours and got a multi-bagger in that quicker than we thought. Sold a little early, but we're not complaining. That one was a good one and a quick one. But that's 10 years off. So the simple answer to everyone getting all hyped up about nuclear, because why it was in the headlines this week, is when everyone stops talking about nuclear again in 3 or 4 months, you look amongst the rubble and you see what makes sense for the next 5 years. And that's really the way that you want to think about these things. Here's some Slumer notes. Okay. Here's the S&P 500. It could be up against resistance here, but on the flip side, you look at some of this, and this has upside. And it's hard to say that when you look at the fundamentals. It's trading at 21 times 12-month, 19 times forward. But I think that guidance is a little light because of the tariff uncertainty, and we're going to get some real resolution in 4 weeks or less. Number one, you had the vote yesterday, or the courts rule it illegal. That will be overturned. I think what people underestimate is, most people spend their life trying to avoid winding up in a courtroom. Donald Trump has basically built a career out of winning in courtrooms. I mean, for the most part, he embraces going to court and loves to slug it out and loves long-term uncertainty, the exact opposite of any rational counterparty. So I wouldn't bet against him on this, getting it overturned, but there's something here from a technical perspective, and I don't want to put a lot of weight on that, that just looks like this thing wants to push higher. Even if in the short term, we got to consolidate in this range for a little bit and maybe check back. But I think as we get resolution, estimates are going to start going up, and people are going to be surprised. And then you got all these poor bastards that were shorting down here and sold in the whole record for hedge funds and CTAs. And we did just get this kind of like pullback on the daily. Here on the weekly, it looks like we could have some more upside. So yes, things that have gone and made us an enormous amount of money in a short period of time, like those options. For one, we did harvest some profits. Now we're sitting on some cash because they made so many multiples. But we'll find things to do right now. I mean, I don't think we are going to have to wait a lot. You look at small caps, there's a ton to do there. You look at sentiment is not fully stretched. I do think we push higher, and I do think we're going to get that money to work very, very quickly. There's no problem putting new money to work in some of these pockets that we love that are just now starting to take off. MSCI Europe, UK. I mean, Tokyo's kind of been sideways for a year and a half now. Hang Seng is recovering here, a little bit of chop the last few days or so, but the direction is up. We're going to share a chart in our pod charts this week that's going to blow your mind in terms of multiples, in terms of growth estimates, etc. 30-year yield went back to the top of the range. We're not worried about that. We discussed the SLR with the Yahoo segment. 10-year yield, middle of the range. This is going down this summer with the SLR, probably back to the bottom end of the range, if not break through. But definitely, I think we could see 375, 360, which means 5.9% mortgage, which means off to the races on the housing theme next year. So here we're up to this resistance level on the 10-year yield. Maybe it goes to the top again. I doubt it. I think we're a little overbought there on yields. Dollar index, well down to the bottom of the range. Do we break down to 95 or do we have a counter trend bounce up here? I don't know, but we did get that minor counter trend that we were looking at and started to roll back over. Maybe we finally break through. That's going to help earnings the second half, going to help international, going to help China, etc. Euro, look at this. This was on no one's bingo card except for the loyal, incredible, amazing listeners and clients of the podcast. Very excited for you. Euros is moving, man. Canadian dollar, how you doing, Looney? Maybe we're going to be your... Trump keeps saying Canada, our 51st state. Maybe we'll be Canada's second through 51st province. Who knows? It's not the right way to say it, but you get the point. I'm joking. Okay, then we got the commodity index kind of flatlining there. It's good to go through some gold. It looks like it's topped in the short term. It's good to go through these. Dr. Copper kind of gives us an indication of China starting to recover here. Copper has a PhD in economics as it relates to the economy. It's going up. The economy is recovering. That's largely driven by China. A lot of voices saying crude going, excuse me, below 50. We'll look at some of this. I think there's stuff to do in the energy space. I mean, Comstock keeps going up. That's our exposure. That's been now 300%. Let's see, 9. So between 8 and 9, and it's at 25 now. So 3+ bagger in a short period of time. That'll probably check back a little bit, but it's going higher. So we love our multi-baggers, whether they're options or stocks. And we like them better in stocks because then the options are multi-multis. Crude, it looks like it's trying to put in a bottom here. I'm happy with just having Comstock, but we've got some AMA questions about servicers that I like. We haven't pulled the trigger on any of them. See any of these other names. NVIDIA will be back up to the top of the range there. I think they're going to be range bound for a little while because with, the key thing with NVIDIA is not a demand problem, it's a supply problem. And I went into a lot of detail on it on the Arabic call. So if you speak Arabic, check that out. But the excess supply capacity from TSMC and possibly Intel, I would say probably, but let's just say possibly, won't be online until mid of 2026. So they're going to be stuck at plus 4 billion revenues a quarter, which is going to bring their revenue growth rate down from a peak of 400% down to below 50%. The multiple will probably get down to the low 20s before mid next year, which might actually be a time to buy it before that excess supply comes on and they can really juice the earnings. Looks like some of these semiconductors are wanting to bottom. The Mag 7 has kind of been stuck here. Apple stuck in the range, Google. And we've said that, the earnings growth has decelerated in those. I think they probably trade back to the top of the range into midsummer, and then we'll have some profit taking. What else do we like here? Consumer discretionary is a spot to start to look. Consumer confidence has come back. We saw the numbers last week. A couple staples. Colgate might be worth taking a quick look at. A lot of amazing things still to do. I got to take a look at Amgen. What else we got? These are Canadian banks. I just don't feel like a lot of these E&P companies If you look at Suncor, they just haven't come down relative to the price of the commodity. So I don't get the leverage on the ups if the price goes back up. That's why I loved Comstock so much. Let's take a look at 30 yield and 10-year. We talked about that. Weekly chart. Dollar looks like it's breaking down. There was the counter trend rally we were telling you is going to happen. It happened. Now it looks like it's breaking down. That will be good for earnings the second half. Let's see. Albemarle. This is from Morningstar, put this out a couple days ago with a fair value estimate of $200. If you sleep on Albemarle, I really feel sorry for you. I think this is going to be a big name. We've talked about it. It's a dividend aristocrat. It's raised the dividend every year for the last 30 years throughout all the normal cyclical peaks and troughs of the lithium price cycle. Supply demand is expected to, we had thought mid-2026. I think this note is calling for it to even happen sooner. This is like if everything goes wrong in our view, again, all this is opinion, not advice. Do your own research, consult your advisor, click on terms on hedgefundtips.com. If we're wrong about this, we think it's a double. If we're right, this could be, 3-4 bagger from here with, options doing 5x plus and all kinds of good stuff. So that's that. Let's get down to our data of the week. I was talking to some friends and I just said, don't count Lip Bhutan out. This is not a guy you want to bet against. If we're wrong on the fab business and he totally screws it up, we'll still get a double on the legacy business. And if we're right, this guy got in Cadence Designs. Look at Cadence. It's really interesting. Software design, semiconductor software design, software used to design semiconductors. And the stock had been basically dead money for 15 years when he got involved, except it had fallen 90% right before he got involved. So dead money and a 90% drop, not dissimilar from Intel. Intel has been dead money for 25 years, okay? It's the same price it was in 2000. It's dropped from a recent peak of about 75%. Lip Bhutan's getting involved. When he did it with Cadence, the stock was a 100 bagger over the next 24 years. I'm sorry, over the next 14 years, rather, from 2009 to 2023, 100 bagger. So if you put in $1 million, you made $100 million. That's not going to happen in Intel. But I do think if he gets the fabs right and catches a couple lucky breaks, which this guy has a tendency to do, I do think it could be a 4 or 5 bagger. And your downside's largely protected if they liquidated the whole thing today, trading at about book. I kind of like it. I love betting on the right jockeys, and we'll talk a little bit about VF Corp today. New vehicle sales forecast for April. The headline for this was like, oh, it's going to be terrible. Look, sequentially, they're expecting it to be down month on month after a record pull forward from tariffs in March. But that's not the right way to measure it. The right way to measure it is to look at April 2024 to April 2025. And April 2024 was pretty good. And we're going to be up on April 2024, even after we up 4.6%, even after pulling forward a couple 100,000 vehicles in March did 1.58 in March. So you could say, oh, they're down 12% month on month, but they pulled forward a few hundred grand and they're still up year on year. So it shows the underlying strength of demand. This is the multiples. These are companies, friends in Dubai sent over from a Chinese sell-side bank, all major kind of discretionary companies in China, and their PE on forward earnings. And you could see here all of these companies. Alibaba, Meituan has a low PE, Pinduoduo, but Pinduoduo is a train wreck. That was down big this week. We had told you for a year that their numbers were either unreliable or unsustainable. That proved to be true this week. But Bob has a 9 times 2026 earnings. I mean, with low double-digit earnings growth, all the outs that we've talked about, this is just unbelievable. So Cheap is in the market with accelerating earnings growth, cheapest AI play, most advanced large language model, leader in cloud, leader in middle class recovery. And China's government now was a headwind, is now a massive tailwind. They want to get everyone spending their $20 trillion of savings. And if they all start consuming, Alibaba picks up 40 cents of every dollar spent on e-commerce in China. It is a toll taker. Inbound foreign visitors recovered to 84.5% of the 2019 level last year in China. You can see here, this is staples are resilient. Discretionary is still a little bit weak, but the government's working on that. Real estate, trading goods drive growth. So they've had the vouchers, et cetera. So you see office appliances, cultural and office appliances up first quarter of 2025 over first quarter of 2024. Big time. Sports and recreational articles up big, 25%. Telecom equipment up big, 26%. Furniture up 18%. Appliances and audio video up 19%. So the government stimulus and vouchers are starting to work to spur consumption. It's early days, and Alibaba is going to get the bulk of that. S&P 500 debt at record lows. This chart blew my mind. Government debt is at record highs. U.S. debt to GDP, 120%. S&P net debt to market cap is at 10%, down from its peak before the great financial crisis at 65%. Look at this, ladies and gentlemen. They have so much room to lever up. It's insane. And when Besant gives them the green light this summer with the SLR and brings rates down, you are going to see huge refinancings, borrowings, deals, everything happen all at once. U.S. equities, rolling 10-year return now 13%, was negative 3% in 2009. So we can stay up at these levels for a pronounced period of time. In this case, it was about 20 years once it got up to that level, from 46 to looks like about early 60s, then from 85 through 2003. And then we just got up there in like 2018, probably goes for another 5-6 years. And that's just the way the cycle goes. You can see here in the total asset class quilt of returns, gold has had 2 strong years. I wouldn't count on that recurring. The last time you had gold do this well 2 years in a row was 2010 and 2011. The following year, it dropped to the bottom of the quilt. And then the year after that, in 2013, it was the worst performer with negative 27%. So everyone's asking me about gold. It's the time to be probably taking some profits off the table. XLV, healthcare versus S&P 500 since Trump election. You can see here, huge drawdown in healthcare. I think that's probably going to be the new area of huge opportunity relative to risk. So we currently have exposure to that through the biotech basket of biotech with the XBI. That it will be starting to recover massively as it did in Trump 1.0. And a few other, Baxter. I think some of these medical device are going to finally start to catch a bid after all the smoke clears. Here is housing forecasting average annual starts to 1.5 million this decade. So you can see it has been clawing back, got hurt a little bit, and now is reaccelerating. That's going to help our Stanley Black & Decker, Generac, and QXO themes. QXO is up a lot in a short period of time. Early basis, $13. I think it got up to 17 or 18 already, and the story's just getting started. So that's moved a lot in a short period of time. Earnings resilience supports V-shaped recovery. You can see estimates holding up. China now more popular worldwide than the US. Net global perception of select countries where negative values dictate negative perceptions and positive percentage indicate positive perceptions. So it appears since 2023 was a peak. That's interesting. I wonder where this table is from. Note to Jeff, make sure you always try to include the source on these. That looks like it's The Economist, which tends to have a little bit of a bias. So they're saying Russia's improving. All right, we're going to toss this one out. Next is front-loaded tax cuts, back-loaded spending cuts, preliminary House reconciliation package, fiscal effects versus current policy. Look, all we want to make sure is that bonus depreciation gets slid back in. And if that's the case, that'll be really, really good for business. China one-year loan prime rate continues to go down. Easing continues aggressively. That's a good thing to see. China business confidence is at a record in May 2025. You can see here growth expectations have now shot through the roof. You haven't seen these levels in years. Interest rates coming off of 5,000-year lows. Rate cycles last for decades. So, you saw in the 1800s, it would go up, spike up, come back down, spike up, come back down. Everyone's looking with recency bias after the 30s. When it spiked up, it just kept going up. That doesn't mean it has to happen. And I think it probably won't happen because of the demography in the global world, in the developed world, is more deflationary than inflationary. So I think this would be a range more like the 1800s than a spike like you saw from 30 to 1980. But, we'll see how it goes. Short-term rates are going down. That's what I can be pretty darn confident about. Housing supply rises to highest level in 5 years. So that's going to start to bring down prices, make things more affordable. Florida being the leading indicator, Texas being the leading indicator. People are starting to dump. Credit downgrades haven't had lasting effects on stocks. 12 months later, they're up in 20% on the 2023 downgrade and 18% in the 2011 downgrade. I mean, it's kind of comical that these agencies are still in business after what they did during the housing crisis, giving AAA ratings to the mortgage-backed securities. But, they're still around and up to the same old shenanigans. I understand the risks have increased, and it's a good way to put the government officials on alert. So hopefully they'll take the proper action in coming months, and we'll see how that goes. But I think the name of the game is going to be that no one's pricing in is growing our way out of this problem. And I think with the deregulation and a lot of the policies that are coming into play, and housing tends to lead the economy. So if they do get the rates down and they do get the lands open and you do see a tremendous amount of building and production, that's going to be enormous for the economy, enormous for growth. And then you get people moving into houses that they own versus they rent. Then they start fixing things. They start buying furniture. They start buying appliances, and it's game on. So I'm very bullish about growing our way out of it versus cutting our way out of it. But we'll see how it plays out. Putting U.S. credit downgrades in context, you can kind of see it visually on that chart. Inventory front-loading delays, tariff-induced price pressures, difference between April wholesale inventory growth and 12-month average. So you can see some durable goods, home furnishings, chemicals got pushed forward, autos got a little bit pushed forward, durables. Long-term dollar sentiment sours to worst on record. That's kind of why we were calling for that counter trend bounce. We'll see if we get any more in the counter trend, but it looks like it wants to break lower. So that'll be good for a lot of our theses that we came into the year with when everyone was convinced the dollar was going higher, not lower. Toyota revs up sales of RAV4 hybrids in the U.S. That's good for Cooper. They make a lot more per vehicle on the hybrids than on the ICEs, and even more on the hybrids than the EVs, which EVs they make more than the ICEs as well. Year-to-date repurchase authorizations have now spiked from 665 billion to 711 billion, record all-time high. The relentless bid in the market continues. Quarterly buyback executions, again, announcements have exceeded executions, but executions are up there. Truck tonnage index versus S&P 500. So the S&P 500 has gone up materially. Truck tonnage has kind of been flat, so we do want to keep an eye on that. First-time home buyers, share of home purchases, well below the 20-year average of 35%. It's less than 20. It's about 24%. Need rates to come down. Share of homes built under 1,500 square foot. We've been talking about this would be the case since 2023. Look what's happened since. It's gone from 17% to 22%. This is going to be the whole game moving forward, is smaller size, massive numbers, huge volumes, helps the arms dealers, not the warring faction, arms dealers, meaning building supply, the Stanleys, the Generacs, the QXOs, the LVMH, the KB Homes, the Pulte's. They're going to be a race to the bottom. They're going to be putting on massive supply on the market at lower and lower margins after they're going to have to offer incentives. Same thing's going to happen with the car dealers. That's why you want to be in the arms dealing business versus the warring factions. AI CapEx growth is continuing to run at a very strong rate. COVID disruption. Yeah, so you can see here, this is China policy, and you can see the easing policy stance has started to be the most aggressive since the 2016 to 2018 period, when the Chinese stock, or Hang Seng and China Tech, went parabolic from 2016 to 2018. This is the most easing policy you've seen in China since that period. So I do think we're going to continue to see follow through in China Tech, Chinese equities, and most importantly, Alibaba. Also, Exhibit 20 from Goldman Sachs, ETF flow trackers suggest the national team has been buying to support the market in China. Cumulative flows to top 5 NT holding China A shares. You can see that in RMB. As the market recovers, they've been massive buyers, and that's going to continue as well, just like the Japanese did. Median S&P 500 short interest as a percentage of market cap. So short interest is pretty elevated here. It's record short interest in small caps. Those are going to be the next rip your face off rally. If you missed the general market rip your face off rally, that's where it's coming next. Dollar can fall again, showing the overvalue of the dollar. Equity put call ratio gets down to these levels. From elevated levels, you see continued good things in the equity markets. Tariffs may not hit every stock equally. We don't even know if tariffs are going to be a thing. I mean, I would bet they are. I think it's going to be the 10% across the board, but an interesting court decision for sure. Whether he can just declare a random emergency and tariff anyone he wants in the name of whatever he wants is now in question. It will be fought. I would say more than a coin flip, he wins, but at least it's now in question, which is kind of interesting because so many of the companies have adjusted to the prospect of tariffs. We heard VF Corp, and they're like, we'll just come out stronger, and here's how we're going to do it. And so imagine if there wind up being no tariffs and they take all the actions to absorb the extra $100 million, $150 million of costs, and then that just goes straight to the bottom line. Now, that's a rosy scenario that's not in any models right now, but like if that happened, talk about growth exceeding expectations. 60-day loan delinquency rate. So this is a bear wet dream chart. It's showing prime auto loans are moving up to 2019 levels, and subprime auto loans are accelerating in a big way. It is what it is. I mean, it's the percent of outstanding. The question is, what percent is outstanding relative to past periods when rates were zero. Now the rates are so high. What is the magnitude of the total portfolio? And the answer is probably smaller, but have to get some data to burden ourselves with the facts on that one. Relative valuations are depressed across key sectors. This is UK 12-month forward PE ratio. In consumer staples, UK, that's interesting. Energy materials, of course. Dry powder buying the dip. Weekly change in money market funds versus the S&P 500. So you see the last time you saw this dip was April 2024. You had a continued rally for all the way through mid-July. I think that's probably the base case. I think we do probably persist higher for the next month and a half, 2 months before we get a little bit of respite in the fall. TSA pass-through numbers good, which is kind of interesting because most of the airline stocks have been left for dead. There might be some things to do there. How higher rates could impact stocks. Different equity investment scenarios on the 10-year yield. Minimal impact where we are. If you get higher, issue for rate sensitives and low quality. Okay, that's interesting. What is this? Citi. What is this? Economic surprise index turning positive. Japanese yields soar. We've told you this is continued pressure on Mag 7. The carry trade unwind will persist as inflation ticks up in Japan. They continue to tighten. As they continue to tighten, the yen gets stronger relative to the dollar. The carry trade is no longer cost-free capital, and most of that hot money was in the most crowded trade, which was the Mag 7, which is why I don't think you can expect a lot more after that basket trades to the top end of the range. And I think you can expect a ton from the other 493 where there's opportunities where they were hit by tariffs, fear of the worst, and wind up with something less. And that's where you get the divergence between expectations and reality, and you get the forced, just as you got the forced structural selling, you get the forced structural buying, as we've gotten a taste of in the last 6 weeks. Bloomberg dollar gauge hit 16-month low. I mean, unbelievable. Everyone was like, you're totally wrong on the dollar, and boom, completely rolled over. We remember all the charts we went over after the election goes up, Trump 1.0, and then it rolls over after the inauguration. That's exactly what's happened. 1 month S&P return versus change in the 10-year yields. Rates rising, rates falling. Z-score, okay. Delinquency rate, credit card loans, and all commercial banks. So, you look at credit card loans, I mean, it's below average. So you look at those subprime auto loans. So yeah, we saw that a little bit last year in Dollar General and Dollar Tree and the lowest of the low end. But in aggregate, delinquencies are below average. So, they peaked a little bit and now they've come back in. 7 U.S. companies make up more than the next big 5 countries in the MSCI All World Country Index combined. The problem is they no longer make up that much more of the earnings, and that's the divergence, and that's why you're seeing a constant leakage and persistent, historically there had been a persistent bid. Now there's a persistent dribble away from those. And I think that continues even if they make it back to the top of the range. 90% of companies in the MSCI outperformed Mag 7 over the past 3 months. This is what we have been calling for, and that's what's taken place. Market share of the 10 largest S&P 500 stocks at different peaks, 38% versus 19%. What's valuable is when they actually measure it against percentage of the S&P earnings, and it's no longer they no longer command that weighting of earnings relative to weight, and that's what the divergence has created, a weight, and that's why they've dramatically underperformed this year. Consensus change in forward 12-month earnings per share. China Tech 100 consensus forward earnings per share has gone parabolic over the last 3 months, up, and U.S. Tech has gone down. Okay. Look at the change in earnings expectations for China Tech versus U.S. Tech. U.S. Tech going down, China Tech going up. Number of S&P 500 companies issuing annual guidance. So you can see here, everyone says they all pulled guidance. It's not the case. They pulled guidance during COVID. They did not pull guidance anywhere near that much in the last with the tariff uncertainty. China by far has the largest share of the global e-commerce market. In terms of percent, they have 55% share of global online retail sales last year. US had 20%. And who has the largest share of China e-commerce is Alibaba with 40%. Not to have a piece of that, I think, is going to prove to, I think not owning Alibaba in the next 24 months is probably going to have bigger career risk for most managers than owning too much Mag 7, which has gotten shellacked. So let's see how that plays out. Buy the dip is back. Average S&P 500 return in session following a down day. Look at the U.S. Treasury yield curve. Oh, this is interesting. This is from Callie Cox over at Ritholtz. Historically, odds of gains increase with holding period. So if you hold stocks for a day, your odds of being up are 51%. If you hold them for 3 months, your odds are 66%. If you hold them for 10 years, your odds are 93%. If you own stocks for 20 years, your odds are 100%. U.S. first home buyers are now older than ever. So repeat buyers average age 61. First-time home buyers average age 38. That is really high, which tells us we've got a lot of pent-up demand ahead of us. Houses will get smaller, prices will go down, supply will go up, rates will come down. So the way to play it is play the derivative, don't play the primary, and that's what we've been talking about for many months now. For foreigners, U.S. dollar weakness compounds the pain of U.S. equities falling. So all those folks crowded into Mag 7 that got smashed, they also got smashed because while their equities fell 25%, they were all crowded into Mag 7. The currency fell another 10% on top of it. So they've just been smoked. Emerging market relative earnings are historically depressed. 12-month forward earnings relative to the U.S., more upside potential, limited downside risk. We haven't seen this since when? Early 2000s, which we talked about forever. Same thing with trailing EPS to world GDP. Again, levels we saw in the early 2000s, which led to the biggest rally in the shortest amount of time in international value versus growth, small versus large, etc. Mag 7 free cash flow growth ex NVIDIA year on year is now negative 11%. You haven't seen this type of negative free cash flow or falling free cash flow since 2021 and 2022, which is why I don't think that basket's getting much higher than the top of the range. And the other 493 are going to pick up some slack. Healthcare market cap as a percentage of S&P 500. This reminds me an awful lot of when energy fell from 9% of the S&P 500 down to 3% in 2020 when we were buying ExxonMobil hand over fist at $33 when oil went negative in 2020. Now it's healthcare. Hasn't been this low as a percentage since 2001 and since 2011. We gotta figure out. I mean, we've got good healthcare exposure, but we got to find some more opportunity because those type of divergences are generational opportunities. Goldman Sachs Social Media Economic Sentiment Index relative to University of Michigan consumer sentiments. We did see the CB consumer confidence actually catch up this week, so that's a little stale. UK retail sales ex auto starting to pick up. That's good to see. In China, GXO has a huge exposure to UK retail or UK business. In China today, it makes sense to borrow to buy back shares. China 10-year government bond yield minus MSCI China index dividend yield. This is the same situation that caused the Japanese government to be buying massive amounts of equities, which caused the Japanese stock market to recover a few years back. And now the same situation is set up in China. Very, very interesting. Again, going back to that 2016 situation where 2016 to 2018, you had a straight up parabolic rally, just like 2009 to 2011. You can just see it over and over. So we're set positioned very well there. S&P 500 average realized stock correlation picked up a little bit. US to Europe trade is still alive. U.S. pensions are modeled to sell $19 billion of stock for month-end rebalancing. That's this month. Ranks in the 89th percentile amongst all buy and sell estimates in absolute dollar value, going back to 2000. That's from Seth Golden. Road to reshoring may be bumpier than expected. That's correct. Natural gas trading above 370 on the July contract. It's going to be a long, hot summer. We agree. Go Comstock, go. More clues to bulls are in charge. That's from Ryan Dietrich over at Carson. S&P performance after May is up 5% or greater. 12 months out is up on average 19.9. 6 months out is up on average 6.4. Bull markets last longer than you think. We're only 60 months in. 2009 recovery, we saw 131 months. 87 recovery, we saw 148 months, and so on. Investor pessimism tracking identical to prior major recovery rallies. Total equity flows 1 month. You can see the drawdown here is coincident with many troughs, and the rallies when it turns green tend to persist for many months. So we're at the beginning of that. What is the taco trade acronym that stands for Trump always chickens out? I think this is a stupid way to phrase it because ultimately you want him acting rationally when the facts are not favorable for forward prospects. And that's what he's shown that he's going to do in the face of positions taken that were initial offerings in a negotiating stance that caused excessive volatility. Created huge opportunity for us, so we're grateful, but I can understand how people would get upset that sold in the hole and now it's recovered on them. But we were concerned that it was an extreme position, but as we, I continue to go back to that special call I did for clients when we went through company by company. I said, look, now's the if you're putting more money in, now's the time. This is like man-made. It started with the tweet, can end with a tweet. Look at the cash flows, look at the earnings, look at the revenues. Let's rock and roll. We can buy them on sale. And so many of you came in and did that. And there's still a great enough pocket of stocks to still do that now that it's pretty exciting. Anyway, JP Morgan sees record outperformance by European stocks. Again, on no one's bingo card, those of you who are listeners in the fourth quarter took advantage of all this stuff. Beating up renewables, starting to perform. That's interesting. Healthcare price to book at 1 times versus 1.7 times historical average. That's consistent with the weighting being so low. So we got to start to dig into healthcare a little bit more. Price to operating cash flow at 1 times versus 1.5 times historical average. Forward PE at 0.8 times versus 1.1 times historical average. Yeah, healthcare. Similar story with energy. Price to book at the low end of the range. Price to operating cash flow, low end of the range, towards the minimum. I mean, this is, yeah, energy and healthcare. We probably need a little more. We might be okay on healthcare, but yeah, we got to keep digging. Rolling 4-week average trends by client type. Hedge funds still underweight, still forced buyers. I wanted to go through, my goodness, we got so much stuff to cover here. I guess we'll just do this one. We were going to go through the whole commodities basket. Maybe we'll do that next week if we have more time. You can just see commercials is a smart money. When they're getting long, they're the longest that they've been since 2018. Been putting in this long base. I think bonds are going to get bid bigly this summer, and part of it will be the SLR. You saw continuing claims today. Maybe the Fed will do a cut or so. You couple that too. Again, the positioning is such. Hedge funds are short in the hole. This is always a formula for massive rip your face off rallies. So yields are going down. It's consistent with the housing theme. It's consistent with everything we've talked about, international versus US, dollar weaker, etc. Goldman Sachs expects stronger yuan to boost Chinese stocks. We agree. We've been saying that for over a year. And it's happened. Alibaba's new instant commerce portal passes 40 million daily orders. By the way, you didn't even know you own that. The amount of stuff that we own as owners of Alibaba, which aren't credited in the stock yet, is just mind-boggling. I've never seen anything like it in my whole career. Alibaba chairman Joe Tsai says company on good path after years of setbacks. Goldman Sachs said hedge funds cut Magnificent Seven, bought China stocks. China's policy rebalancing toward consumption. Ki Jin says Intel CEO Lip-Bu Tan has a long track record in the chip industry. Now he needs a big customer. He will get that big customer, not because he's necessarily the best. I'm not saying Intel's going to be better than Taiwan Semiconductor, because he's going to be in a duopoly, and there's only 2 games in town, and they're going to prop up. They're going to prop up Intel like Weekend at Bernie's and make a bunch of chips. They will be the king of the inferior chips, but the amount of demand is so unlimited that the crumbs are going to be enormous. And based on where it's priced, those crumbs are going to have a monstrous effect in operating leverage straight to the bottom line and into the price of the stock. Toyota goes all hybrid with its best-selling U.S. vehicle. Toyota sales hit second monthly high on U.S. tariff rush. Honda CEO is all about hybrids now that EV adoption is pushed back 5 to 6 years. Lilo and Stitch, Mission Impossible fuel Memorial Day record. Lilo and Stitch is Disney. Bernstein says U.S. gas supercycle is coming. We love it, baby. Comstock and Range Resources. My goodness, that thing, I've had that thing since 2018. It's unbelievable. Now, basis 410, dropped to 160 during COVID, and is getting up there. I think 55, 60, we got to start to take some off on a 410 basis. Boeing stock has been surging. Here's why it's become a FOMO play. So sold to you. We took multi-baggers on the options. We kept every single share of stock. We will be riding that higher, but I think it's gone very far, very fast in a short period of time. And sometimes you just got to book a huge win. Bessent sees easing capital rule on treasuries this summer. How you doing? SLR, we've been talking about it. Get ready. New home sales unexpectedly surged despite high mortgage rate as builders lower prices. Again, warring factions versus arms dealers. Play the arms dealers, not the warring factions. A building boom on federal land. It just might work. Everyone wants more housing. The government needs to make sure it gets built, and the government will. Emerging market, this government will. Emerging markets said to see the next bull run as the sell the U.S. narrative gains ground. I think everyone has this view that it's either or. Like, if you think international stocks are going to outperform, then you think U.S. stocks are going to do bad, or U.S. has lost its way. No, U.S. has just pulled forward a ton of gains. They now needs to consolidate. International and emerging markets have been left for dead. Now they have to catch up. I mean, it's not complicated. You don't have to make it ideological. Just deal unbiased with the facts. Where is the opportunity? Does it mean you like one form of government over another? No. Well, clearly I like capitalism over communism all day long. But the prices have gotten so cheap in China that don't have exposure to it. It's okay. We'll be fine. Don't have exposure to energy in 2020 when managers were getting fired if they owned an oil stock at the lows, and then 2 years later they were buying it at the highs because they also had career risk. I mean, the market in the short term is a voting machine based on emotion. In the long term, it is a weighing machine based on fundamentals. Leave all the ideology, leave all the emotions, leave all the bullshit on the sideline, and focus on the numbers. The only reason you put $1 into an investment is because you expect to get multiple dollars at some point in the future. So you have to be careful. What are you paying for today's dollars, and what are you paying for the future dollars? So many people bring me great companies that are going to do all the miraculous things that they say they're going to do. The problem is they are priced today as if all of those miraculous things already happened, and these people are making bets that they're going to double price for what hasn't even happened that will happen, but you're already paying for what's going to happen. Therefore, if 10% less happens, the stock's down 70%. And that's what happens over and over, and that's why we continue to say avoid shiny objects and focus on things that you can put massive amounts of money to work and sleep like a baby at night, because they're in a cyclical trough or they're temporarily impaired, high quality businesses that are temporarily misappraised. Over and over, rinse and repeat, take your doubles and triples on to the next, and live a happy life and play a lot of golf. What else can I tell you? Moving on. Healthcare stocks are so bad they're good. What to buy now? All right, Ben Levinson, tell me what to buy now. Let's see what he's got. Ben's telling me to buy the healthcare spider ETF. All right, we have the biotech. He's leaning towards United Healthcare. He's probably right on that. Humana, okay, in the targets. Danaher, yeah, kind of like that. Gilead, maybe. AbbVie, probably. I like this article. Look, Barron's is awesome. Ben Levinson's a legend. He's put out a lot of good stuff, so that's a good starting point. Why value investing has worked better outside the U.S. Good article in Morningstar. And that's now changing. What are they talking about here? International value. Alibaba is the #1 weighting in the International Value and Growth Index. Beyond Europe. This is a good article. Pull that up at Morningstar. Investors pile into ETFs at record pace despite market turmoil. U.S. exchange traded funds have collected some $437 billion in new assets so far this year. They bought the dip just like they did in COVID. Advanced auto parts stock soars 55%. Guidance is holding up in the face of tariffs. So they're executing on everything they said. They delevered the balance sheet. They shut the unprofitable stores. They consolidated the distribution hubs. And now they're opening up new stores in the areas where they're #1 and 2. And it's working. Oh, and by the way, another dog has started to rise from the dead like a phoenix from the ashes. Canada Goose sales up unexpectedly rise as luxury spending holds up. High-end coats posted a 7.4% increase in fourth quarter sales, ahead of consensus estimates for a slight drop, and the stock is now starting to rip. Clean up to comeback stock market and sentiment results, advanced auto parts and vans. So you can see AAP is coming off the mat now. We'll just quickly go through some of the key points. You can read the full article at hedgefundtips.com. It is entitled Clean Up to Come Back, and that's kind of the story with both vans and with advanced auto parts. Love the title, Jeff. Good job. And so let's just go through some of the key points here. First, pro segment, which makes up 60% of advanced auto parts sales, continues to perform well, posting low single-digit growth for the third straight quarter and delivering 8 consecutive weeks of positive U.S. pro comp sales. That momentum has continued into Q2 with strength sustained through the first 4 weeks. Supply chain consolidation continues to progress, reducing the network from 38 varied distribution centers to 12 large distribution centers operating on a unified warehouse system. Look, this is what he said he was going to do. This is what he's doing. He's just doing it a little faster than expected. Completed storefront footprint optimization in March, well ahead of the original mid-2025 guidance. Cash expenses for the plan are now $150 million for the full year, down from $200 million estimates. Transfer sales related to store closures were strong, primarily in the pro segment. Advanced Auto Part is entering a new phase of store expansion, opening 100 new stores in the next 3 years. That is not the sign of a company that's going out of business. That's a sign of a company that's just getting started. Store concentration and density have increased, with 75% of the footprint in markets where Advanced Auto Parts holds the #1 or #2 position. Operating margins for the full year are still expected to be between 2 to 3%. Q2 is tracking in line with the state range, with further gains expected in the second half. Most importantly, Advanced Auto Parts remains well on track to meet its 2027 target of 7% operating margins. All major company KPIs continue to improve. Store availability rose to the mid 90%, up 200 basis points. DC labor productivity increased by low double-digit percent versus fiscal year 2024. Time to serve improved by 10 minutes down to 40 minutes. Okay, total exposure of advanced auto parts to China is only 10%. Management reaffirmed its full-year guidance of $8.4 billion to $8.6 billion in net sales, 0.5 to 1.5 comp sales growth, 2 to 3% operating margins, and 150 to 250 in adjusted diluted earnings per share. This is, it's starting to reaccelerate. That's what you want to see. Do-it-yourself is showing signs of stabilization. So you can go through all the details here. And then Vans looked a lot worse than it actually was, or VF Corp rather. Vans is where the pressure is. They're still generating free cash flow. Cash flow is going to be up year on year. That's the name of the game. They have the runway. Bracken is delivering. Okay, so Vans was the big hit, down 20% year on year compared to an 8% decline in the prior quarter. 60% of the decline, however, was due to deliberate cleanup efforts, including closing 8% of global Vans stores and reducing exposure to unproductive value channels, 35%, along with inventory normalization in China, contributing another 25%. These headwinds are expected to fade sequentially and fully lapse by Q4 of this year. So this game is over. Adjusted for these actions, revenue would have been down high single digits. More importantly, these efforts drove significant gross margin improvement in Vans. This is exactly what he did at Logitech. He increased gross margin by 900 basis points during his tenure, and you had a 28 bagger in his last turnaround deal. If you put in $1 million when Bracken got involved in 2013, you got $28 million out when he left. So you can see here in 2013, he got in, the stock was down over 85% and went straight from $5 to $131. We're going to see something like this in VF Corp. This guy is going to turn it around. It's just, I can't emphasize this enough. When these things turn, it starts to happen overnight. So it's a long time. It's like when you drive by, when they're building a skyscraper, you drive by every week for a year and it looks like they're making no progress because all the progress is going on building the strong foundation beneath the surface. So when you look from street level, you're like, there's no building. Like, what the hell is going on? But meanwhile, they're 30 levels down, building that foundation, laying the foundation. And once that foundation is in place, you see 50 stories go up in a matter of months because the foundation has already been set. The same is the case. North Face grew at 4.4% year on year, driven by 9% growth in global DTC. All regions contribute with double digits gains in Americas and EMEA. Outerwear was the standout, while footwear continued to grow across all regions. Management successfully delivered on the initial $300 million gross cost savings target. Plans to achieve $500 to $600 million in net operating expansion, plus 10% margins by fiscal year 2028. So he's doing the exact same playbook that he did at Logitech when the stock was down 82%. Adjusted gross margins reached 53%, up 560 basis points year on year. You don't see margin expansion of 560 basis points in a business that's doing poorly. While adjusted operating margins improved by 400 basis points, management reduced debt by $1.8 billion during the year, a 26% year on year decline, ending the quarter with 4.1 times net leverage, down a full turn, remains on track to reach 2.5 by fiscal year 2028. Net debt now stands at 4.94. Less than 2% of total U.S. imports are sourced from China. Management estimates the annual gross tariff impact, current 10% rates, to be about $150 million, but expects to fully mitigate this through cost actions and optimized sourcing. New products at Vans continue to see strong demand. Super Low Pro launched in Q4, sold out its top 2 styles almost immediately. Management expects continued momentum throughout the year, with back to school and holiday season starting to see influence on the new global brand president, Sun Cho, who came from Lululemon. Timberland's continued strength with sales up 13% year on year. Strong DTC growth combined with fewer discounts drove significantly higher margins for Q20 for fiscal year 2026. Management expects free cash flow to improve from $313 million, excluding profits from one-time non-core asset sales, while also anticipating full-year operating margin expansion. Inventory reduction continues to progress, down 4% year on year, though it would have been higher during the quarter without accelerated product shipments into the U.S. during the 90-day tariff pause window. All right, so you can go through the highlighted parts. Morningstar put out an article after earnings saying fair value is $40 a share. They're obviously being very conservative, but optimistic relative to consensus. We think it's going to be a lot more with Bracken, and could be a very, very many multi-baggers. Canada Goose, the free cash flow is going through the roof. The stock is starting to rebound up almost double off the lows and just beginning. So you can go through some of the details here and what's happening on all fronts. They're executing on exactly what they said they were going to do. Sentiment is improving to 65, but it's nowhere near extreme levels. So there's probably some more upside. And I think on balance into July, we remain pretty damn constructive. So biotech earnings, I think this is going to be an area of opportunity. This has been slow coming, but when it comes in this group, it comes all at once. And the last big move, by the way, was in a similar period to what we've been talking about with China, 2016 to 2018 off the lows, more than double in the index, 150% move in a year and a half. I think we're kind of set up for something like that right now with all the pessimism around the group. And we'll be very excited to see that finally start to manifest. So earnings are down across, but that's kind of, one of the things, there was a chart showing the number of, the number of biotech stocks now trading. Let's see here. I gotta actually pull this one up. All right, so here's the chart I want to show you on biotech that we missed in the earlier. Biotechs trading below cash are at an all-time high. The number of biotechs trading below cash has spiked since year-end 2024 and reached an all-time high of 133 in March 2025. Number of biotechs trading below cash. On a percentage basis, more than 20% of biotechs are trading below cash, i.e. liquidation value. Percent of biotechs, sub-cash. I mean, this is unbelievable. This is another generational thing. Sentiment has gotten so extreme. We should probably have more exposure here because this type of stuff happens once in a career. So thanks for Steven for sending that over. Appreciate it. All right, we got that. Oh, insider buying in VF Corporation. Bracken Darrell, Abhishek Dalmia, and Richard Carucci, CEO, COO, and director, collectively purchased a total of 185,000 shares of VF Corp, with prices ranging from $11.73 to $12.05 per share. The total out-of-pocket cost for these purchases was $2.2 million. So while everyone was selling down from 29 down to 12 on tariff fears, and the people who have the most perfect information were buying every share they could get a hold of, as were we. Okay, as far as data, the big thing tomorrow is going to be the core PCE and PCE. Trump met with Powell today, said, I want rates lower. Trump said, pound sand. Let's see what the inflation numbers look like tomorrow. Maybe there'll be some additional pressure, especially after these employment numbers today were a little bit weak. Continuing claims were higher than expected. And initial jobless claims were higher than expected, etc. Earnings estimates are holding up at 265 and 300. I think they're going to actually reaccelerate. Most people are calling for the opposite. We'll see what happens. With that said, we're done with the podcast part of the podcast. We're now moving on to the Ask Me Anything questions. And I have to warn you, we have more questions than I've ever seen. So stay for as long or as short as you'd like. But there are a lot of good questions and a lot of good companies that we're going to discuss. So stick around if you can. And if not, we'll see you next week, same time, same place. I'm in California for the next few weeks. So excited before going back to New York the end of June. So let's see here. That's the problem. I need to get to the inbox. All right. Okay, so Joe Cook asked, "Happy Thursday. Thanks for everything you share. If you own Leaps and Baba, and then Ant Group has an IPO, will that be good, bad, or indifferent for Leaps holders? What may or may not happen with Leaps? Look, Leaps, you have any options held in the U.S., you have a risk. It's a risk we're willing to take because we have so much stock. Even if the options go to zero, we're going to make enough bags on the stock that it will more than make up for it. But if you only own options, then you're just being a gambler, and you still have delisting risk. You still have all that. As it relates to Ant, we own 35% of the equity in Ant, so that will just accrue to the value of Baba, which should push the value and or price of we own the stock in Hong Kong 9988 up, and commensurately the Baba shares and or options related to the shares in the US to the extent that they stay listed. We have made progress on the talks with China. Therefore, I do believe that it continues to be unlikely that it's delisted, but it's not zero risk, which is why we pushed all of our shares into Hong Kong as a hedge. And that's that. But the Ant factor is not an issue as it relates to that. It should be a net positive. Okay. Next one. Thank you for the question. Nick Davies asked me to play golf in the UK. I don't have any plans to go to London, but I might have to go to Portugal this August. So in which case I'll probably find a way to slip through based on the courses that you listed in your email, because they're once-in-a-lifetime courses. Okay, AMA question for podcast. Love the cast. Tune in every week. Wonder if you take a look at Lionel Basil. I like the whole group. I think we covered it last week, so I'm going to spend 2 seconds on it. But the short answer is it's definitely warrants a deep look. We don't have any position and probably don't intend to, but we do have some positions in related companies. So this one I think we didn't get excited about because cash flow hasn't really confirmed anything other than prices down for a reason. But I do think that's at a cyclical trough, and you're probably spot on there. Okay, we got Nick. Ivor, FMC and Dow, same thing. We've covered these. We like them both. Definitely warrant doing more work, but I think these groups are going to start to recover abruptly. Chemical and ag related names. Dow I was less confident in than FMC, but let's just take a quick look. I think Dow might have a little more trouble. Yeah, Dow's still negative cash flow, free cash flow. So I want to see that start to inflect, but FMC looks a lot more promising if I recall. Yeah, they're cash flow positive. They're just in a cyclical trough. I kind of like that one. So good work. Let's move on to the next one. Tom Florence. What other energy names besides CRK are interesting to you? None yet. They haven't come down commensurate to the price. So we'll keep looking. I think we're more interested in the servicers. There's going to be a question on Halliburton. If gun to our head, if we had to buy something more than that. Bottom line is, I don't need to own everything. When I size a position, we're trying to own 8 to 12 companies in a portfolio. So if we've got exposure, we're already, if it's an 8 to 10% position, we're already overweight. And then because it's gone up 3 bags, it's making a bigger and bigger weight on the portfolio. So we have enough energy exposure. We're not in a rush. And that's I got a portfolio in today, and they ACAT'd, or last week, they ACAT'd the portfolio in, and there were like 100 different positions in the portfolio. It's so, guys, do your work on a handful of companies and just own a concentrated portfolio of things that backwards, forwards, upside down, and sideways. You can't be competent in that many things, and that you don't have to be involved in everything. If you get a handful of good decisions, you're going to do extremely well and know everything about it. So just ignore the noise, own a handful of good companies, and you'll be very, very happy. Okay. To trades and then how to. Okay, so York is asking questions about trading. So York, you're obviously brand new, younger kid in college, looking for trading advice. Puzzled by VF Corp's move up only on disclosure of inside buying. I mean, $2.5 million is serious buying. When the stock's down that much and you see insiders write a check from their own pockets of multi-million dollars, that's pretty important. So why were banks surprised? Banks weren't surprised to see anything. The market saw that as a vote of confidence for management. The underlying stock price got too despondent in the short term relative to the underlying fundamentals, which haven't really changed. And that was the move. So I think you're overthinking that, York, but it's a great question, and there's your answer. Lachlan Neo, thoughts on CK Hutchinson Holdings, 0001 HK. Let's see. H. Wow, generating a lot of cash, low multiple. What do they do for a living? Let's see here. Industrials, investment holding company, ports and ports related services, infrastructure, telecom, mainland China. 5% yield. I mean, this is the problem, and this is why there basically only a handful of companies would ever consider owning in China. On there's going to be so many companies on paper that look incredible in China that turn out to be disasters. I don't think this is where you want to play. I think you basically want to own Alibaba or Tencent. The reason I didn't like Tencent is I don't like the gaming business. The government generally hates it. They're allowing it to happen right now just because they need China tech to recover, but their fundamental view is that it's a bad thing for society, and eventually they're going to come after it once they have the runway to do it. So Baba has the most outs, most opportunities, and the most things that government wants to promote right now. So just keep it simple. Don't take country and company risk. You're taking country risk with China. It's a communist government. So you don't want to take country and company. Baba, as goes Baba, so goes China. So, you know, what I said when Baba was down in the 60s and 80s is we're buying it because as bad as Xi Jinping's decisions have been around policy and around its actions towards Alibaba, it's mutually assured destruction. If he destroys Baba, he destroys himself, and he'll be carried out on a stretcher by another Tiananmen Square. So he blinked a year past what we thought he would blink. He could take a lot more pain than we anticipated. But sure enough, as you saw social protests going up in terms of instances on the chart, which we tracked every single week, eventually he finally blinked when he realized his power was at stake. So now he's full throttle because he realizes he's got to take things to the promised land, and he doesn't want 20% unemployment among 25-year-olds who are educated and angry. So he flipped it. He started massive stimulus. It's now catching traction, and it's going to be straight up over the next 2 years. Milan Kirshner. Hi, Turnaround Tom. I've been following you for 3 years now and shared your podcast with my family members. Just want to say thank you for your amazing podcast. Well, thank you. The more I listen, the more I realize you're a Buffett in the making. Okay, there will only be one Buffett. So very kind words, but no one's in that category at all. I'm unique in what I do with turnarounds. It's probably closer to what he did when he was running outside money with partnerships than what he did once he had a permanent capital vehicle, but grateful for the kind words. Generous with your time and share your knowledge for free. I'll be a future client of yours soon. Thank you, Tom from Canada, Milan. Okay, no question there. Well, Milan, I think you're going to be a client sooner than you know. Very grateful for the kind words, and it's nice to hear that because we put a lot of work into these every single week. Jim Jeffries, thanks for your time. Listened to the podcast and shared with friends for years. Thank you. By the way, if you're not a client and you don't do any business with us, that's absolutely fine and great. We're happy to deliver this value. The only thing we do ask is if you are getting value and you think this would benefit anyone in your sphere, friends and family who love the markets, please share the free podcast with them. They will get value, pay it forward, and good things will happen. So very grateful for that. Feel like we talked about this back in October 2023. What do you think about IFF after its slump back towards the 5-year low? I have been looking at it. I'll be honest. I'm not going to say anything one way or another. We don't own any shares yet, but it's one that we are exploring because it does have a moat in its own little niche, and it's in a cyclical trough, and it's got runway, and we just want to have a little more clarity with the turnaround plan and make sure it's a temporary versus a permanent impairment. But I think you're spot on with that one. Absolutely think you're spot on with that one, and warrants much further work. Goran Stoychik. This week I started position what seems to be an emerging turnaround story, Cleveland Cliffs, because of their dominant position in U.S. automotive industry. Electrical AI transformers will benefit from increased domestic auto production. Cost-cutting steps, another turnaround stories. All right, let's take a look. I don't really like this name, but let's take a look. Historically, I don't. It just tends to chronically fail. You're probably going to be right. I don't know if you're going to be right from $8 or $4, but it is a cyclical stock. Let me just see if it's got the runway and it's not going to risk getting stopped out. Yeah, no, not for me. This needs to change. I need to see some positive free cash flow and evidence of a turnaround, not a gamble on a turnaround. Let me just see. Maybe they've done that on a quarterly basis. No, there's still negative free cash flow. I don't like it yet, but I'll keep an eye on it. And I like the way you're thinking, but too early for me. All right, next, Tim Sanders. Thanks for sharing your insights on the stock market. Always appreciate it. Love to get your thoughts on Builder as a potential housing recovery play. Yeah, let's take a look. BLDR. I feel like we did this one recently. Yeah, revenues and cash flow still going down, consistent with the price, as are margins. Let's take a look here. Yeah, this is not for me. I mean, this is one. I mean, this has already had a 200 bag, so the fact that it's down 50%. I mean, if you get it perfect, you're going to get a double. But you might get hurt. This is a momentum. This is a broken momentum stock at this point, and I'm not seeing trends start to move back in a positive direction after 200 bags. I'm going to just pass for now. Play it better through Brad Jacobs. You know, you're buying Brad at the beginning stages of growth down here, and not the ending stages after you've had a run up. So it's probably a good business. Let me just take a look here. There's just not enough margin of safety. If I could be down 50% or up a double, I don't like that 1-to-1. I need to be, you know, down 30% or up 3-4x for me to risk real capital. And this is just not giving me the risk reward that I'm looking for right now. And I don't see a reacceleration of trends yet. And historically, it hasn't been a great business. So I'm going to just leave that one there. Theme is right. Execution expression is wrong. How do you feel about Campbell's versus Hormel? I don't like Campbell's. We covered that. Frank Brown. Rocket Mortgages. Yeah, I think this is better quality than United Wholesale Mortgage Corp. Let me just take a look at it. You definitely can win on this when the game comes back. So it's consistent with the theme. Yeah, it hasn't turned yet, but it will. This is just a gamble on the a leverage gamble on the theme. I think that one's probably the better play than United Wholesale Mortgage Corp. So you're probably right there, Frank. I don't love it. I'd rather just play it through the way I have it expressed than, focus on that. Yeah, so this guy's talking about, cash on the sidelines is not an indicator because when you take the cash to buy stock, the seller gets the cash. But you're missing the whole point. The point is that when risk appetite is on, the seller then takes that cash and reinvests it in more stock. And on balance, more risk exposure is taken in across all asset classes, and the asset class of money markets is diminished, which is the measurement that we're referring to. So, and then you take another step in terms of margin that is being drawn, which is also at lower levels, which is also a sign of risk aversion that has a lot of capacity left to be much more buying power than there's a lot less margin drawn and higher cash balances than you would ordinarily see any time near. We're at levels you see closer to bottoms than you see closer to tops is the right way to interpret it. But thank you for the question. Welcome to the podcast. On to the next. Rory McMullen, what's your opinion on SMR play? So headlines, price goes up, everyone chases shiny object. I would say it's fine for now. It'll probably go higher. Get interested when everyone forgets about it and it drops 30, 40%. And that's not the way I would play small modular reactors. I'd play it with bigger companies. I like their CEO buy-in. Balance sheet looks okay. That's from Eric Klein. BYON. Beyond negative free cash flow, collapsing revenues, collapsing margins. What do you like about this again? What does this thing do? What is this? A website of the former Bed Bath & Beyond or something? I have no idea what this is. Beyond Inc. Where's the website? Let's see what they do. Yeah, Bed Bath & Beyond. So, okay, so they bankrupted the brick and mortars. Now they have a website. Look, on a chart basis, it looks cyclical. It probably recovers. But on a fundamental basis, I can't put money to work here. I'm not seeing any signs of a turnaround yet. Balance sheet's probably clean because they went through bankruptcy. Let's see. Or at least the parent did. Let's see. Cash 159. Long-term debt 0. Yeah, so this is Newco, I guess. And free cash flow negative for 3 years. I don't know. This is a trading vehicle. This is not a good quality business. Revenues have been declining for 6 years. They can't even blame it on COVID. Oh, they had a peak, okay, in 2021, and then they've cut in half. I mean, I don't know. If you're certain that this is the bottom, take a trading punt at it, but I wouldn't touch it. River, unless they've laid out a turnaround plan that makes an awful lot of sense and they're credible managers, I don't see it. River Rahe, been sharing with as many friends and family, but it's remarkable how many people get scared of 2-hour podcast, VideoCast. So don't listen to 2 hours, listen to a half hour, get 25% of the value. What can I tell you? Listen to 10 minutes, get, 5% of the value. Completely up to you. I give more than is expected of me. So you could take or leave as much as you want. But anyway, listening to your podcast for 2 hours every week has saved me years of work being closer to retirement. Appreciate all you do. So you're the one that benefits, and the other ones that can take 2 hours. Look, I'm condensing 80 to 100 hours plus of man hours worth of work per week into 1 or 2 hours. So you decide if that's valuable to you. Based on the numbers, thousands upon thousands of people have found that that's valuable, and we're glad to do it. But we'd love to do 10-minute or 20-minute podcasts. You're just not going to get any value, and it's kind of a waste of everyone's time. So back to the matter is, if you want results, it takes time and it takes effort, and there's no shortcuts. So the people looking for shortcuts, go follow some trading guru, blow up your account in 6 months, and then 2 years from now, you can come back after you missed one of the greatest opportunities to buy high quality businesses at low prices, and you can learn it. And 4 years from now, you'll be a decent investor. Okay, so his question is, can you take a look at Civi, C-I-V-I? Cash flow. Free cash flow positive. What do these guys do? Guess is their energy. E&P, low quality E&P. Let's see. These type of guys scare the hell out of me. When you see a stock that's split adjusted from $5,000 down to $6,000, and then it's 10 bags. This is scumbaggery at its finest. Anyone who did this kind of stuff to stock it's just maybe they've changed management, maybe they've done this or that, but for me, they don't get a second chance. Anyone that does that type of value destruction to owners belongs in the wall of shame and should never work as a public company CEO. So now it looks like they're recovering revenues, they're recovering cash. I'm just not going to take a bet. Maybe if it's brand new management and the management is from credible places, then fine, have at it, understand the assets. Maybe it's a great opportunity. For me, I don't like to play in those low quality E&P names. It's just too, with Comstock, I'm betting with a proven winner. Like, I don't have to think about it. And I'm betting pari passu. I bought it basically at the same stock price that Jerry Jones owns 70% of the company. I don't have to think a lot. I mean, only the public markets can give you that opportunity. In the private markets, he'd have 80,000 promotes ahead of me before I've even made $1. The price would never get that lower because the offering would be so highly valued based on his name and his track record of success. That's why what I do is the greatest job in the world. Nothing comes close. I see private market deals. There's nothing like what we do in the public markets. We benefit from the short-term voting machine of euphoria and despondency and the price movements that diverge dramatically from underlying intrinsic value. There's literally no game like it in the world. So that said, let's go to Theo Dumont. Theo Dumont, Peter Schill Partners. Okay. Peter Schill. Okay, UK equity, that's kind of interesting to me. Cash flows declined along with stock price. Revenues are de minimis. What the hell is this thing? Private equity firm? No way. Private equity firms are made up of sell-side investment ex-sell-side investment bankers who historically have figured out a way to extract value versus trade value. There's nothing wrong with it. It's just in their DNA. They're extractors, not creators. And I just don't like the cultural fit. Never have I heard I invested alongside a sell-side investment banker and got rich. I mean, let's just pass on that. I appreciate on paper you are right, but I've been to this movie before. They will do well. You will not. Bob Atkins, I enjoyed your weekly video cast for months and appreciate your insight. Love that you put your family first and admire that quality. Thoughts on Halliburton as a drilling play? I think if I had to add another energy play, gun to my head, which I don't, this would probably be the first place I'd look. And the second place I would look is Schlumberger. I think that's the way to play it, because if oil prices stay low, kind of like MLPs, but MLPs, you don't have a similar upside. Again, these just haven't come down enough for me to get excited. But I think Halliburton's probably a better play. I think the cash flow is fine. I think the revenues are fine. I like it. I like it, Bob. Good one. All right. Next. Jimmy Jones, Oscar Health. That's Kushner's brothers promote. Let's see. I think they're doing some interesting things there, but it's still like a speculative. Oh no, they're now generating a ton of cash. Okay, well that's good. OSCR. I mean, was this a SPAC? This might be, it's funny, I was talking with some super incredibly smart people in Dubai, and we're trying to brainstorm, like, quote unquote, what's uninvestable now. And it's like, quote unquote, failed SPACs. Like anything that was a SPAC has a stigma attached to it now. I think this might have been one. This one, you just really have to understand the business, because like it's very hard to break into healthcare as a startup. Offers health plans to individuals, families, employers, healthcare system, engagement. Enterprise value is 1.64 billion. What are they doing in terms of business? It's a lot of cash they have. Great balance sheet. $1 billion of free cash flow. Jeez. All right, so this is one I got to look at and understand the business, because this is like a too hard pile, but it's kind of interesting given the players that are involved and how low the valuations got. So so I think on the surface you're right, but now you got to really dig in and understand the business. All right, so Agatha and Rex, thank you for the long 5-page analysis of carry trade and petrodollars and all that stuff, but there's nothing about that gives me anything actionable about buying a piece of a business and making money on it. So I'm not going to spend time on it. That's for some macro podcasts pontificating about things that may or may not happen that have zero value on how we invest. Chris Brooker, Doc Martens, DOCS. Yeah, I'm seeing a lot of these stores pop up around here. Was at Fashion Island today. Dr. Martens, PLC. Wow, look at that. Revenues are down, cash flow is up. DOCS. Huh, look at this thing. Why is this so... See, I hate these plays. Even like Crocs, I can't stand, because it's a bet on a fad persisting for longer than 12 to 24 months. That's why, like VF Corp, you got a lot of outs. This, you're just betting on, like, are you at the end of the fad, the beginning? Because it's cyclical. Doc Martens were big when I was young. Then no one would wear them for 20 years, and then it just keeps coming back. Market cap, 557 million pounds. What is the, let's see what's going on here. Revenue's declining a little bit. What's happening to share count here? Share count's coming down. Balance sheet, 140 million. How much debt? 300. It's kind of okay. Enterprise value, 1.4 billion. What kind of cash flow again? All right. Yeah, I just want to understand how sales are going to reaccelerate. But generally, it's worth exploring and understanding the turnaround plan, how they're going to reaccelerate sales, because it looks okay. I'll probably never wind up in it just because you're betting on one brand and the fads are too hard to predict. But you might have a decent enough margin of safety if you do the work. So there you go. New client inquiry. Matt in NC says, just a comment, no question. Why I need Tom Hayes managing my account. I work in a taxable account. I was going to have realized gains from all the successes I've had using Tom's advice. Well, it's opinion, not advice. So I thought I would get smart and sell my Advanced Auto Parts stock and options on 5/8/25 for $32 per share to actualize an offsetting loss with a plan to simply buy it back in 1 month on 6/9/2025. After all, this has been dead money for years. Also, just to be, quote, safe, I set a price at $34, figuring if it jumped, I'd simply get back in and accept the wash sale. But of course, the price gapped up from 32 to 44. Now it's over 50, by the way. And marked open 5/21 up to 48 in a day, and I missed the 50% move. Can't wait to hit the $1 million mark and fork my money over to Tom. Avoid acting on bad ideas like this one. Thanks for all you do. Avid listener now, about 4 to 5 years. Yeah, man, look, I appreciate, that's very kind. And you're right. I mean, I give you a tremendous amount of value, but at the end of the day, the intangible that makes all the difference is not knowing it intellectually. It's knowing your strengths and weaknesses. It's like, no one calls me up and they say, hey, Tom Hayes is a great investor and he knows everything about business and financials. Let's call him up to be the CEO of a multi-billion-dollar company. Maybe he can operate the whole business. It's like, that's not, you got to know your strengths. And it's like the intangible, the ice in the veins, the turnaround Tom, the knowing what you own. It's like, you can understand that intellectually, but you either have it genetically or you don't. And like 99.9% of the people, like, I'm a genetic defect. Like, God gave most people a FOMO gene, fear of missing out. They got to be involved in everything because their neighbor's getting rich on this, their neighbor's getting rich. I didn't get the gene. Like, the guy next to me could make $17 billion on Bitcoin in a week. I'd just be super happy for him. I wouldn't be like, oh, I should have bought Bitcoin. That's not what I do. It's like, it's like a professional hockey player. It's like, why didn't I make 80 million as a professional basketball player instead of 8 million as a professional hockey player? It's just not what you're genetically designed to do. So you kind of acknowledging that is smart. And that's 99% of the people. Honestly, the smartest people in the world are not the people like me. It's the people who build businesses, sell them for hundreds of millions or billions of dollars, and then hire a guy like me to grow it for them. And they sit on the beach and they play golf and they enjoy their life and they don't have to think about this. This is a 24/7 thing. You got to be thinking about all the time. I mean, and in order to do it and do it well, you have to love it and you have to be a genetic defect that is actually wired to do well from this type of business. Because what makes most businesses work and most entrepreneurs rich is the exact opposite of what makes one successful in this business. In the real world, as an entrepreneur, you get paid for massive action equals massive results. Fail fast, keep going, fail fast, keep going, fail fast, keep going. In the investing business, it is exactly the opposite. Thoughtful, diligent work, make a couple smart decisions, sit on your hands, and have the discipline not to get faked out. until you realize intrinsic value. Why? Because you know the underlying business, you know the trends, you've done the work, et cetera. And that's just very few people are genetically wired that way. So the value is in understanding it intellectually and then being extra smart like Matt and saying, you know what, I'm going to go build a fortune, build a couple businesses. You know, why so many people get rich in real estate? Yes, it's tax advantage, but more than that, they can't sell. They don't have daily liquidity. If they get a headline that says pending sales are down, they can't flip out of 16 apartment buildings. They just have to hold through it until the next cycle. And then they hit the window and they, you know, make many times their money because they are forced holders versus easy sellers in the euphoria and despondency of the voting machine that is the stock market. So really brilliant insight there, and you'll be there faster than you know. Max Hughes, what do you think of ADM? Archer Daniels Midland. I think I've been looking at this one a little bit. I think you're probably right there. If I'm not mistaken, this is a dividend aristocrat, and we're at the bottom of the cycle like the FMCs. We were going to go through commodities. We don't have enough time. Yeah, just want to see a little bit of improvement on the free cash flow before we go hand over fist. But I think you got a decent enough margin of safety here, and it's a good enough durable business that I mean, if you got blessed and could get it with a 3 handle, you should try to do that. I'd be in no rush to jump here, and I'm totally happy to miss this one, and I probably will. But I think you're generally spot on. I'm just cautious on that free cash flow. Let me just see what the balance sheet looks like. I mean, businesses that have been around for decades, it's just a question of runway. So their balance sheet's a little weaker than it was. Let's take a look at the debt. Yeah, they'll probably still be okay, though. It's just never been an extraordinary business. But I think with something like this, you put a $40 alert. If you get a high 30 handle, you probably buy a little bit and start to do the work, in the meantime. I think you're generally right. The question is at what point and when, and is it the highest and best use of capital? And I think for me, it's not the highest and best use of capital. Hi, Tom. Love all your videos, watching everything you post. Appreciate sharing your knowledge. Nucor. Steel stocks generally suck. I think we even covered this last week. I don't think it's come down enough. Just a simple answer for my appetite. These things, these are the definition of not only... I mean, it's the best in the bunch, but I mean, I don't think relative to the way revenues and margins and cash flow have fallen, I don't think the stock has fallen enough yet. So I'm going to pass. And if it gets lower, I'll revisit it. Dennis Amato. Have been listening to your podcast for the last couple of months. Believe your value approach is quite sound. I think you've stated a couple times that you're beginning to look for ways to play energy. Was wondering what you think of Helmerich and Payne, HP. Yeah, I've looked at this one. I think this falls into that Halliburton category, but Halliburton is a better play. Higher quality. Yeah, I think on this one, you want to kind of start to see that cash flow turn. Yeah, I think you just want to... You're probably okay with this one. I would rather see you in Halliburton, to be honest with you. This is unreal. Frank Penber, hardest lesson you've ever learned in your investing career? Don't chase shiny objects. Peyton Hops. Love your deep value approach in a world of cookie cut investments. When it comes to Comstock Resources, you called the relative bottom. What signals are you looking for to start eyeing an exit, reducing your position? How much does the Ukraine-Russia war ending or tariff trade deals change the future demand of natural gas? That's fucking, excuse me, that's noise I have no control over. I could care less about that. As far as the intrinsic value of the stock, we've covered it in the past. Proven plus unproven, 15 years of unproved reserves that's not recorded on the balance sheet. PV10 is the only thing reported to the SEC. The answer is a lot higher. It's been a triple. I think it could probably almost double from here. So that means it'll probably be, when all is said and done, at least a 5-6 bagger. All right, next, hand Jancock. All right, so he's saying, should I buy QXO now that it's run from 13 to 18 or whatever it is? You say you never buy on green days. Hope you don't hate abstract questions. I do hate abstract questions. We're here to make the listeners money, but I appreciate you sending the question. The answer is, I don't know. I don't know. Like, new money in today, am I buying QXO up, 50% in a month? Probably not. I'm probably going to look for the things that haven't moved yet. And maybe if it gets back to 15, put some money to work there. But yeah, look, if you're okay buying it at 18 and it goes to 10 before it goes to 80, then you should buy it today. So I don't have a good answer for you, but it wouldn't be my first choice today. Let's just put it that way. Cork Snyder. Start my bike ride from San Francisco to San Diego for mental health May 30th. Got a large sponsorship for the cause in Teva pharmacies. What are your thoughts on that? Teva is a generic. That business has been decimated, and I think it's finally recovering after all the lawsuits and everything else. It's up a lot already, but it probably has more room to run. It's not my first choice of highest and best use, but I think it's higher and maybe materially higher 3 to 5 years from now. If you're going to play generics and this falls into healthcare bucket, this is probably a decent spot to start. So good one, Cork. Good luck. And then Nikhil Jain, Vistry Group, UK home builder. Let's take a look. Yeah, I think this checks a lot of boxes, but again, I'd rather play the arms dealers than the warring factions because their margins. This is probably fine. Let me just check the balance sheet here. Yeah, I think you're okay. I think decent play. It's a good find. Just get a little comfortable with the turnaround story and you're fine. So nice find there. I'd rather play the home builders, but the building suppliers, but as far as that goes, it checks enough boxes. I like it. Thanks for sharing. Well done on the money show. Really nice presentations, keynote, nice work. Team, all the update, big kudos. Thank you. If you could only pick one of Brad Jacobs' businesses, gun to your head, would you go for GXO or QXO? Probably QXO. I think GXO is probably a triple or a quadruple. I'd say no. I would say it's probably a triple from here, whereas QXO from where we bought it is probably a 7 bagger. It'll just take longer. So guns not to my head. I don't have to pick one. That's why I own both. And I'm happy with that decision. Quack. Should the Japan bond market be something to worry about? Well, we were talking about that all last year. So you're a little late on that because the drawdown in Mag 7 as a result of that already happened. Now they're going to bounce back to the top of the range. So yeah, continue to keep an eye on that. But it all predominantly is going to affect is the high concentration in Mag 7, which it already has. Sebastio Pinheiro. My name is Sebastio. I'm a huge Portuguese fan of yours. That's great because I'm half Portuguese and own some land over there. You once responded to a comment of mine about the great golf courses here in Portugal, and I was very glad to learn about your connection to my country. Sending you this message to ask you about Synovus Energy and Biomarin. Ooh, he's sneaking in too with all that sweet talk. All right, you're going to get away with it, my man. My Portuguese brother here. Synovus. The problem with Synovus is it's a lower quality E&P. For me, it's not the highest and best use. It hasn't come down enough relative to the operating leverage and probably the leverage in the balance sheet. So no, I wouldn't play that one. It'll probably be okay, but for me, it hasn't come down enough relative to the low quality of a business it is, which can catch cyclical turns. Biomarin, I think, is a better play. You just have to understand the pipeline well enough, but I do think you want to get some. We don't do individual names in biotech, but this is more of an established pharma company. It kind of looks like Biogen a little bit. I think this is one that's on our target, that if we did go into an individual pharma stock, this would be high on the list. Just, it takes a lot of work on the pipeline and everything else to get confidence, but I think you're definitely on the right track, and probably do fine with that. That could be a double for you. Next, Adam Dyer. All right, he's asking all about the SLR rates, currencies, all this stuff. It's nonsense. Pick a business that generates free cash flow that's growing. The weaker dollar will be a tailwind related to your question. But Adam, you're complicating things and focusing on the things that don't matter and not enough time on the things that do matter. The underlying business, the free cash flow, the revenue growth. Stop worrying about all the macro noise that you can't. Yeah, we have a view that rates might do this and the dollar might do that, but it's unrelated to the equities. The equities are trading. The micro kind of gives us the view of the macro, not the macro giving us the view of the micro. It starts with the business. It starts with the bottoms up. And then you say, well, why did the price get so derated? And then you start to see, well, it's because of this condition and this condition. Well, are those conditions at an extreme enough levels that they could inflect and create an unnatural tailwind for the business, which is naturally improving? Yes. So that would be a double tailwind, but the business has to have an intrinsic tailwind, and that stuff is just kind of noise that takes you out of the field. QXO launch. Okay, so he's asking about the offering. Here's the bottom line. All you need to know about QXO, because people keep asking me about the offering. Brad Jacobs put $150 million of his own money at QXO when it was in the hole. Okay? QXO, 2000, not QXO, XPO, 2011. I don't know if it was 2009 or 2011. It doesn't matter. Bottom line is, stock was an 80 bagger or a 160 bagger, depending when he put it in. I think it was 2011, whatever. Okay? He's put in $900 million of his own money before I did. Okay? So any follow-on offerings he thinks are net beneficial at the price and for the reasons and in the structure that he's done, he thinks that his $900 million investment will be better off in the future than it is today by doing the offering. So on that basis, considering he's got meaningfully more skin in the game than I do, and he's got a proven track record of doing this 4 or 5 times, I'm supportive of any offerings that he does at the right price, especially when the stocks move so much in such a short period of time. It's already absorbed it, and they're going to use that thing for creative acquisitions now that they have a platform company, and they did it in the convert. I like how he did it. I like why he did it. But as far as what do I have to worry about, he's got 900. He's got 800 million more reasons to worry than I do. So I would just trust the process with Brad Jacobs and not overthink that. This is not some scumbag that's getting paid $1 million and sucking $1 million of options out of the company and has no net worth and is just a salesman running a company. This is a guy who is a principal investor alongside with us and happens to have operating prowess and a history of creating wealth for his owners, namely himself as the biggest owner and all the other folks that are lucky enough to ride along with him and let him do all the work and make us tons of money. So for me, I'm 100% supportive of that. Longtime listener, this is Martin Grzywaszewski. Global payments. No, lower quality than PayPal. This thing has always had hair. I don't like it as much. I think it's probably works. Let's just take a look at some of the financials. I would stick with PayPal. I forget what the hair was in this business. Something I hated about it from the past. Software solutions. Yeah, I don't think this has as much of a margin of safety. Let me just take a look here. $15 billion of debt, $2 billion of cash. It's a lot more leverage than it's never really compounded money at a decent clip. This is a lower quality business. I don't want to own this relative to, if that's the choice, you own PayPal. There's no question. It's not even in the same neighborhood. Like, could you make a trade off of this? Low quality business for a double, maybe, but PayPal's a whole different game, whole different leadership, whole different plan, whole different stronghold. Okay. Griffin Brown, hope you had a great trip. Have you ever built a position based off a listener's idea? Not yet, but a lot of good ideas are coming in. So could happen sooner rather than later. Sensata. What is this, a beaten down chip play? Sensors, sensor solutions, performance. So this is like a chip autoplay. Kind of like this one for a double. Let me just make sure you're going to be in business. Take a look at the balance sheet here. Generating free cash with balance sheet. $600 million of cash. $3 billion of debt. They brought it down a little bit. Yeah, look, I think if you can understand the business, understand how this top line number is going to reaccelerate, share count's coming down, I think you're probably okay there. Got to understand it a little bit better, but I think you're on track there. Good one, Griffin. Daniel Garner. From a Money Show Miami follower. Hey, Tom, French luxury LVMH. Yeah, this is a high quality business. Let's just take a look here. I mean, this is definitely a compounder. It's not for me, but I think if you own this thing for a while and you're not worried about short term, I think long term you're going to make good money with this. I have to produce for my investors in a reasonable amount of time, 24, 36 months, meaningful production. And I think this is going to be a longer term play from these levels, but I think it's a good business and will continue to be a good business. So cash flow has kind of been flat for the last 3-4 years after spiking a lot in COVID. They've been able to retain those levels. Margins seem okay. This is all blocked out. Let me just see if I can get rid of net debt. The cash flow is totally recovered. Let's take a look here. These got hit with China. So revenue peaked, it declined. Let's take a look at quarterly, see if it's starting to come back. It's been managed well because despite the revenue decline. Yeah, so 3Q, what, where the hell? Hold on for a second. Okay, the quarterly is not active. All right, ROIC, cash flow. And what a balance sheet. Well, 42 billion of debt, net debt. All right, 42 billion, 14 billion of cash. Take a look at the share count. Yeah, I don't think you really go wrong with this. I think you're right, Daniel. I think it's great. I think it's a good price, a great business at a good price. I tend to like good businesses at great prices. So, you know, Buffett evolved. I have not, but you know, but when Buffett was managing outside money in his partnerships, he liked, you know, good businesses at great prices. And then, you know, he says that Munger didn't convince him to do anything. He was always running the show. And what changed was not Munger whispering in his ear, because Munger was whispering in his ears when they were both running partnerships. What changed was he went from having outside partnerships where he had to produce outsized returns in a relatively short period of time, 24, 36 months, to a permanent capital vehicle where he had free float coming in every single month, more than he could possibly invest. And he wanted to be in long-term compounders that he could just set and forget. And if they, you know, like BYD, he bought in 2019, had, you know, 50 to 80% drawdowns before 2020 when it went up 12x in 1 month. And then the IRR over 11 years made sense. If you're managing outside money, you can't do that. So I think if you're just buying this as an individual and you're not accountable to anyone but yourself, and you're, you know, 50 or younger, like, yeah, this thing's going to compound over time and it's going to benefit from the China recovery. And I think this is a no-brainer. I mean, I absolutely love the idea, and well done. Okay. Got that. We're done. We'll be back next week. Same time, same place. In the meantime, make it a great one. Bye for now.